It's 9 a.m. here in New York City on this Tuesday, December 3rd. Welcome to Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures holding steady after the S&P 500 closed out its 54th record high this year. The benchmark index currently on pace for its best year since 2021. Its 27% rise this year, spurning short sellers, according to strategists at Citigroup, who note investor positioning in S&P 500 futures is completely one-sided, and short sellers are now throwing in the towel.
Plus, Fed officials keeping the door open to a December rate cut. Three policymakers on Monday making it clear that they expect the central bank to continue cutting interest rates over the next year. Fed Governor Chris Waller saying that he is inclined to vote for a rate cut at the December meeting, but he did say, though, that any data before then could make the case for holding rates steady. Investors will get the latest read on the economy today with job openings data.
And a Delaware judge striking down Elon Musk's record-setting pay from Tesla again. The judge saying that the board was improperly influenced by Musk when it adopted the billionaire's plan in 2018, even without the payout. Musk remains the world's richest person. His space exploration company, SpaceX, is said to be in talks to sell insider shares that would boost the value of the company to $350 billion.
The S&P 500 coming off its 54th record of the year on Monday, and more signs of unwavering demand for U.S. stocks. Joining us now to discuss what the next driver for this record rally could be, we want to bring in Cameron Dawson, New Edge Wealth, a Chief Investment Officer. Cameron, it's been remarkable just taking a look at the continuous, I should say, record highs that we have seen in the market this year. Are there any signs to you that this could be abating anytime soon?
Well, at least not through the end of the year. We know that seasonality is typically a strong tailwind. In December, you get that positioning chase, you get performance chasing, and you also get that notion of wanting to defer taking capital gains, which in a year like this, when markets are up so very much, it just suggests that people will want to shy away from selling. Now, of course, that then leads to the question of what happens into early 2025, and that's where we have to contemplate things like stretched positioning, as you mentioned earlier, as well as stretched sentiment, stretched earnings expectations, and valuations that are, by all definitions, very elevated versus history. So we think all of those things will eventually weigh on returns at some point in 2025. But for now, the trend is up. For now, momentum is strong. It's just a question of course, how long can it last?
I want to stay on that earnings growth and the expectations there, Cameron, that you brought up, especially considering what FactSet was noting within some of the Q4 earnings growth expectations, and actually saying that banks are better positioned than some of the semiconductors that are out there. You know, how do you kind of look into the momentum that we've seen for semiconductors and the run higher versus what the expectations for some of the forward performance may look like going into 2025, as you mentioned?
Well, I think that's a really interesting question when we think about the prospect of this broadening out trade. Of course, we had the very narrow leadership from an earnings perspective all through the first three quarters of the year. But that fourth quarter, this quarter that we're in right now, is really where the rubber will meet the road as to whether or not we will see other things lead the market. So as you mentioned, banks, industrials, healthcare, all areas that are expected to see a recovery into the fourth quarter and into 2025. So if you look at third quarter earnings, the 493, the non-Mag 7 names, only generated about 0.1% earnings growth. That's expected to go to 12% this quarter in the fourth quarter. So that's a big test once we get into reporting season in January.
Cameron, when it comes to some of the leadership that we have seen, I guess the big question for many investors coming out of this holiday shopping season is the strong consumer. I'm curious what that tells you. Does this tell us anything about current market sentiment and maybe how that's going to carry over into 2025?
I think the strong consumer is confirming this idea of a risk on market. And one of our favorite indicators is equal weight consumer discretionary stocks versus consumer staple stocks. This ratio has a good predictive power of where the consumer is heading. So it actually tends to lead turns in household consumption forecasts. And so what you saw back in a year like 2022, people were cutting their forecasts. Discretionary was underperforming staples. But ever since the beginning of 2023, we've seen consumption forecasts go up, discretionary outperform staples, and that ratio is really showing no signs of rolling over. So if we start to see discretionary underperforming staples, that would really cause us to raise our eyebrows, question the consumer. But for now, we're not seeing that trend change, which just suggests that the equity market believes that this consumer remains resilient.
To what extent is the 50 plus all-time highs that we've seen on the S&P 500 this year, and now kind of looking out into next year, how much of this market activity is really baking in just a continued policy pathway for the Fed remaining undeterred in 4 potential rate cuts? It seems like most economists are in the camp of 1 every quarter.
Yeah, what that distills down to is just how much of the upside we have seen this year has been driven by multiple expansion and why we find ourselves at 22.5 times forward. And part of that comes from this expectation that the Fed is going to be our friend, even if we don't see distinct economic weakness. Now, we've been of the camp that in order to see the Fed continue this path of rate cuts, so cut again in 2025 after December, that you have to see a good reason for them to do so, meaning you might actually have to see economic weakness simply because if you look at where financial conditions are today, they remain extraordinarily easy. That Chicago Fed Financial Conditions Index is now back to its 2021 levels before the Fed started hiking rates, which just suggests that there is a risk if the Fed goes on this path of continuing rate cuts, they could stoke a fire of a financial bubble, which is certainly something we saw back in the late 90s when the Fed cut then. So it's a risk to the upside for markets, but also in the long run, potential dampener for return.
So Cameron, then does it make sense, do you think, or does it make more sense for the Fed to pause then now?
We've been thinking that they should and that they will, so that they will cut in December, and then we're going to get a hawkish dot plot when they do their forecast for 2025. Right now, there's 4 cuts marked down for 2025. We think that that could get marked to something closer to 2, which would effectively say it gives them the door that's open to cut if they feel that they need to, but also not to commit to cuts. So we think that at the end of the day, the neutral rate this cycle is higher than it was in prior cycles. This is an overhang of a decade and a half of quantitative easing, the terming out of debt, which made this economy less sensitive to short-term interest rates. All in, it just translates to fewer cuts by the Fed and higher for longer rates. Of course, all that goes and throws out the window if we were to see a dip in growth or a entrance into a recession, but we're not seeing signs of that yet.
Okay, 28 days left in the year, even fewer trading sessions than that. We're going to start getting some roundups of top ideas going into 2025. What's your early candidate for your top idea next year?
Well, we're sticking with quality. And I think that in times like this, it's very easy to be able to look at very low quality, junky parts of the market, which have been leading over the last month. If you look at things like ARC, unprofitable tech, they're all up about 30%. We think that that could continue in the short run, which just means that quality likely takes a back seat, at least for a period of time. And on weakness, we would be buyers of that, saying that we want to buy companies with strong balance sheets, strong free cash flow, really across sectors, meaning that we're finding opportunities for upside, regardless of what sector a stock is in. And we're also finding a lot more opportunities down market cap, more in mid cap than in small cap, where we still see significant valuation discounts versus large cap peers and a lot of potential for upside appreciation.
Quality insights as always. Cameron Dawson of New Edge Wealth. Thanks so much for taking the time here with us this morning ahead of the opening bell.
Thanks for having me.
Shares of U.S. Steel are sinking in pre-market after President-elect Donald Trump pledged to block Nippon Steel's acquisition of the Pittsburgh headquartered company. In a post on Truth Social, Trump vowed tax incentives and tariffs would keep U.S. Steel strong without investments from a foreign company. Henrietta Treyes, who is the Director of Economic Policy at Vita Partners, joins us now on set. Thanks for joining us here in studio this morning.
It's great to be here. Thanks for having me.
Absolutely. Let's discuss this a little bit here, because if CFIUS ends up recommending that first President Biden block this deal, as the Peterson Institute for International Economics noted, this would be extraordinary. The first presidential CFIUS decision, one of only 7 such deals officially blocked by CFIUS in its history. What is the significance of this and the likelihood that we could see this deal blocked?
You know, CFIUS is taken extraordinarily seriously in D.C. The senators like to weigh in on this. Treasury is obviously an integral part, the Pentagon. I mean, this is really the best of the best. So their recommendations are not designed to come without a consideration of literally every component, what's best for the company. It has been diminished materially since its founding in 1901. It is not a major employer anymore, but politics gets in the way of this, as we're seeing from President-elect Trump's tweets, and that's something to take very seriously. But CFIUS is designed to take out the politics, and CFIUS is taken extraordinarily seriously. Senators like to bolster it as much as possible and give them as much credibility and credence as they can.
What about the implications for U.S.-Japan trade relations, or more broadly speaking, global trade relations?
Yeah, on the trade relations front, it's a very big deal because we know that President-elect Trump has in the past put Section 232 tariffs on Japan with specifically steel and aluminum. They've negotiated ways to get that off, but the U.S. needs Japan, particularly as we gear up to go really hard at China. That trade escalation is already expanding. China announced this morning that they're restricting some of their critical minerals exports back to the U.S. This is a situation where we need allies, and the Biden administration operates with that in mind. The Trump administration has not historically.
Are any of the kind of introductory tariff and tariff talks and even teasers about what could potentially be implemented, is that starting to rattle through economists' minds and reforecast some of the GDP growth projections even? Absolutely.
I think you're seeing it from bulge bracket banks and economists. The White House itself is trying to gear up to have key players in place that can telegraph to the markets, hey, our goal is not to drive inflation up through the roof. It's not to hit big box retailers, though that is plainly what will happen. A lot of folks in a lot of our clients are calling me saying, you know, hey, these 10% tariffs seem like they're smaller than what we were anticipating from Trump on the campaign trail versus the 60% that he offered. And I think we are starting to get into the place where we understand that you can use different tariff rationales for different things. So you can put a 10% tariff on for fentanyl purposes. That doesn't restrict you from putting 25% tariffs on under Section 301 investigation purposes, and so on and so forth. And there's myriad of those opportunities.
Do you think that's why the markets have very much just discounted or kind of brushed aside, I think for the most part, the threat of these tariffs?
I think they're just not ready to face the fact that they're definitely coming. There is this perception that somehow these tariffs will not go into effect. I don't buy that argument. We've had tariffs now for 7 years because they went into effect, and that's on our allies and foes alike. So March 31st, for example, is a big date to watch for the EU-US tariffs coming back into place. Immediately, you can put the tariffs on China, whether that's via IEPA. You know, Customs and Border Patrol can change tariff rates in 12 hours. So I think this is all a very real threat. The market's sort of waiting, trying to run out the Trump trade opportunity, but it's coming for us.
I mean, and as we're thinking about what those different tranches could look like, or the different targeted areas that tariffs could impact, how are you kind of prioritizing which would be the most detrimental near term?
The biggest basket to watch is what we call List 4B. This is a basket of about $180 billion worth of extremely consumer-facing goods. Things like milk byproducts, alcohol byproducts, scented candles that you're buying for the holidays, everything that they sell at grocery stores.
Candles, my gosh.
That's how I feel. But those have never been tariffed. And what we heard from the Biden administration in a meeting last month was effectively, if it was easy, we would have done it. And as we go to combat China, that's the only basket of imports that we do not currently tariff. That is the very inflationary piece. List 1 and 2 are industrial inputs. I think those would see the highest rates. They're already on at 25%. List 3 and 4A is where it starts to get into your big box retailers, flat screen TVs, et cetera.
What do you think is the biggest question or outstanding question right now for the markets about the incoming Trump administration?
I think staff is really important, understanding how involved Kevin Hassett is going to be versus Scott Bessent and what that looks like as they go up to Capitol Hill and try to get House members to vote on the tax bill. I think what's really critical, and this is so wonky, but they need to go to the Budget Committee and get the deficit authorization number. That number that we'll get in the next 30 days, probably 60 days, is going to tell us what the deficit appetite is of the Republican Party. And the deficit appetite is going to be the counterweight to whatever the tariffs we need, whatever tax hikes we need, whatever IRA tax credits we need to see repealed, where the SALT cap can go. This is the most critical number that we're going to get in just the next couple weeks.
What is the probability that the deficit would actually get cut into then, with everything that we've been kind of laying on the table here?
The deficit's going to increase, for sure, literally no question. I think the magnitude's going to be about $2 to $2.5 trillion. If it's bigger than that, you could get a longer extension of the existing tax rates. It's important to be clear that we're not talking about tax cuts. We're just avoiding a tax hike at the end of next year. And we need $4.6 trillion to fully offset that cost. We don't have that kind of deficit appetite. So $2.5 trillion is what I'm expecting.
I'm curious just what you make of the makeup that we have right now of the cabinet, just the personalities at play. Lots of talk. We asked Mick Mulvaney, we had a chance to speak with him last week, and he was saying the most important, I think my exact question was, who was the most important member of the cabinet that Wall Street needs to watch? And he said it was actually Trump himself, just given the influence and given who he has stacked up within the cabinet. I'm curious to get your perspective on that.
I agree. Obviously, President-elect Trump is extraordinarily supportive of these tariffs. And you're seeing that in his personnel decisions, specifically with Kevin Hassett, I think, and Howard Lutnick. And I am most interested in Jamieson Greer at USTR. He's the one who will be responsible for the Section 301 tariffs. Those are the biggest basket of tariffs. We can do, 232. We can do IEEPA for fentanyl or immigration between Canada and Mexico, and those are all very disruptive. But he will be responsible for renegotiating the USMCA and for the China tariffs. That's a very big seat.
Great insight, Henrietta. Thanks so much for joining us here on Set.
Thanks for having me.
Coming up next on Morning Brief, we're going to count you down to the opening bell on Wall Street after U.S. stocks closed out another record high. Plus, a judge striking down Elon Musk's record pay package. We'll bring you those details. And what's next for Intel now that CEO Pat Gelsinger is out? We'll discuss that and much more on Morning Brief.
You're watching The Morning Brief, brought to you by Invesco. Now it's time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Let's go to Tesla, TSLA shares. Elon Musk's $56 billion CEO pay package rejected for a second time by a Delaware judge. Yahoo Finance's Alexis Keenan joins us now with more on what's next in this legal battle. Hey, Alexis.
Yeah, so let's just remember what it's all about first. So this was the deal reached in 2018 for Musk's CEO pay at Tesla. It reached its maximum all performance-based value of $56 and change billion, struck down a second time by Delaware's head chancellor in their chancery court there. In Chancellor McCormick, Kathleen McCormick, she said, despite Tesla holding a second shareholder vote in June, where Tesla shareholders, a supermajority of shareholders said they wanted to go ahead and give this pay package, she said that wasn't going to be possible to reapprove it. She wrote in her order, a stockholder vote alone cannot ratify a conflicted controlling transaction. The decision, it hangs on a procedural issue, a legal procedure, where McCormick is saying that ratifying, that revoting and trying to, quote, ratify, that had to be done before her first decision, that Tesla and Musk, they can't go back in time and try to re-up this as if it were in the past. At the heart of the problem, if you remember, was Musk's conflict of interest with board members who voted on that first pay package, combined with Musk's sort of de facto control of Tesla. So that was the heart of the problem. He was subjected to a very high standard to get this vote approved. In a post on X, Tesla responded. Musk retweeted this post, saying, promising they will appeal to, it goes to the Delaware Supreme Court now. They said the judge overruled a supermajority of shareholders who voted twice to pay Musk what he's worth. The decision is wrong. If it's not overturned, they said that means judges and plaintiffs' lawyers run Delaware companies rather than shareholders. So going forward here, in terms of what's next, that appeal, right, would go to the Delaware Supreme Court first. Maybe someday it'll reach the Supreme Court if parties don't get what they want. But also watching Musk's focus on Tesla, because at issue in this case was Tesla saying, well, he needs to be given the pay package he was promised in order to keep his attention there. Otherwise, why would he continue to be motivated to run this company and perform as he has in the past as CEO?
Talk to us just about how much this pay package was worth and is worth today, because there's a pretty dramatic difference between those two totals.
There's a difference between those two totals. So at the time of this litigation, $56 billion, it's fluctuated since that time, depending on the market price, but there is a strike price. And what's important is to Tesla, the value that Tesla has to account for on its books in order to give this pay package. In 2018, when it was given, it had accounting charge of $2.3 billion. But in the court filings, Tesla has said and estimated that it would cost it something to the tune of $25+ billion to give an equivalent pay package today. So that's something that Tesla's really going to have to think about as it goes forward. Shareholders are going to have to think about. We're watching the stock here, of course, today to see if there's any major reaction, worried about those figures there.
I would think that the fiduciary duty to shareholders would be enough to keep his attention at Tesla, but maybe not. Maybe I'm wrong.
You never know.
Who knows? $56 billion goes a long way.
It does go a long way. A couple $1 billion.
Gets your attention.
Goes a long way. All right, Alexis, great stuff. Thanks so much. Yeah. Another trending ticker that we're watching today is Intel. CEO Pat Gelsinger's abrupt exit really rocking the stock, or rocking Wall Street yesterday. You can see a bit of a give back here this morning, off just about 0.8% decline in yesterday's trading day. We want to bring in Mandeep Singh. He's Bloomberg Intelligence Senior Tech Industry Analyst. It's great to have you on. So I think the big question, day two of this story, is very much, we talked a lot about what this means ultimately for Intel, how this could really impact that turnaround strategy. But what does it mean for some of its biggest competitors? Is this an opportunity for some of them to gain even more of an advantage?
I mean, look, for a company like Intel to have this sort of uncertainty when they were not executing well, if you are a customer of Intel, which I think a lot of the hyperscaler and the enterprise companies are, when it comes to the Intel CPUs, you would rather go to NVIDIA, which you were going there already for the AI accelerators, but overall, chip strategy would revolve more around, focusing on a stable company like NVIDIA right now compared to Intel. And that's where the risk is, for the board to bring anybody new without having the sort of credentials that Pat had. really would create more uncertainty and probably market share loss to hyperscalers doing their own chips, or even for that matter, Apple, or everybody who is doing their own chips right now when it comes to the processor, whether it's accelerators or CPUs. And a lot of companies have already pivoted to ARM-based ecosystems. I think that's where Intel has the most risk, given this uncertainty with Pat leaving the company.
If the wrong person is selected to now fill this role, does that put Intel in a position where they could very well already become a political punching bag, knowing what President-elect Trump has said about what the CHIPS Act implications could look like once we see the changing of the guards in D.C. and the removal of some of those dollars that have been earmarked or at least stretched out in such an obscure period of time?
Yeah, I mean, look, I think there was clearly some sort of disagreement between Pat Gelsinger and the board around the future strategy, which is why this sort of happened abruptly. And if they really want to split the foundry business with the chip design business as separate companies, I think it begs the question, where does the CHIPS Act money go? Probably to the foundry side, and then how do they really revive the core chips business, especially on the PC side? So that's where, somebody internally probably may be a better option. But at the same time, I mean, Pat Gelsinger had all the credentials. So the fact that he couldn't turn it around just goes to show how tough it is to turn around a company like Intel.
What's your assessment, just of Intel's ability to compete with some of its rivals at this point?
I mean, the thing about semiconductor chip making is once you fall behind, and we have seen this, over the course of the semiconductor history, the dominant company continues to gain share, and, they really have sort of a monopoly that Intel did back in the day with CPUs. And it feels like a similar thing is playing out in the accelerator world with NVIDIA dominating that market. And it's very hard for Intel to catch up to, NVIDIA on the AI accelerator front. At the same time, the core PC CPU market is still a pretty sizable market. I mean, we're talking about 250 million PC shipments a year. And if there is an AI leg to it, that means everyone is looking to upgrade to AI PCs. That will drive an acceleration, and x86 is still the dominant architecture. So that's the cash cow that Intel needs to protect, or whoever they appoint as a new CEO really needs to make sure they don't end up losing share on that CPU front.
When you think about what we've seen in terms of the stock price activity, both after yesterday's decision, sure, there was a little bit of a pop that we saw, but overall, I mean, we're looking at the past 52 weeks. The stock is down by about 44% here. As you think about what investors can look to in the future, how quickly do you think this company can mount a turnaround, if at all, and how quickly it would pass through the shares? We only got about 15 seconds.
Yeah, look, from a sum of the parts basis, a lot of the bad news is priced in. And look, if you start breaking down the company into its parts, sell the Mobileye division, the Altera, all the non-core businesses except the core CPU, you can improve the, the look and feel of the margin profile of the business and raise a lot of cash, which should please investors in the near to medium term. But there's no way you can revive the company as a whole. And I think that was a challenge that Pat wasn't able to execute on.
Mandeep, thanks so much for the time here this morning, just ahead of the opening bell. Everyone, we've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief.
You're watching Morning Brief, brought to you by Invesco. We're looking at the opening bell on Wall Street. Let's do a check of the markets as we do ring the start of today's trading day. You're looking at a mixed picture here at the open. Some gains here for the Dow. We mentioned the record-setting close for the S&P yesterday. The Dow here this morning pushing up just about a fraction here, up about 0.1%. You're looking at the S&P pulling back just a bit, trading just below the flat line. I want to make too much of the action that we're seeing right here at the open. We're waiting for the Nasdaq to calibrate here as we do see tech under a bit of pressure here. We've got the Nasdaq Composite off just about 0.33% here so far this morning. Taking a look at the Russell 2000, that small cap index just below the flat line here on today's trading day. When you take a look outside of the equity market and zero in on the bond market, some action there. You got the yields off just about 1 basis point at 418, so pulling further back here. But not too long ago, we were right around the 4445 level. So again, an important trade to watch here. And as we get into even more earnings later on this week, let's take a look at the sector action. Again, a mixed picture here this morning. You've got utilities and energy among the outperformers here slightly at the open, followed by financials. On the flip side, consumer discretionary actually off just about 0.2%. You have technology off about 0.6%. Take a look inside the Nasdaq at some of those big tech names and some of the behavior that we are seeing here at the open. Some of those larger cap names under a bit of pressure. You have Nvidia off just around 0.1%. Amazon also trading to the downside. You have Tesla off just over 1%. On the flip side, Google and Meta holding on to some of those gains there. But again, as you can see, lots of red on this board. It's early though, and we're not too far in the red, so still time to turn some of this around. Let's get it over to Jared Blickery with a closer look at what we are seeing here. Jared.
That's right, Shauna. We got plenty of time into the close. So let's take a look at, I'm looking at the S&P 500 here. I'll give you the year to date just for frame of reference, up almost 27%. Ryan Dietrich out with the latest seasonality stats saying that in December, in election years, almost always positive. I think it was the last 10 of the 11 times was in fact positive. And part of this is resting on volatility coming down. Now here's the VIX. I'm going to show you a 3-month chart. This is the lowest print that we've had in 4 months, so the lowest on this chart. You can see a 13 handle. That's pretty low historically. And so that is just kind of shepherding us into this quiet time of year. Although we do have some catalysts coming up. We got non-farm payrolls this Friday, the big jobs report. We got CPI. We got a Fed meeting in the middle of the month, and we'll have to see what comes of that. Here's the sector action. Energy had been leading early on, utilities leading now, but I want to get to some of the mega caps and just show you Apple real quick. Apple has been on a tear, has been reaching record highs 2 days straight, so we'll see if we can make it 3 in a row, but this is a nice bullish pennant formation that it's breaking out of right now, so you got to think it might have some momentum. By the way, the Mag 7 index yesterday was also at a record high, so some of that coming back as well, because the Mag 7 has kind of lagged since the election. Now here are semiconductors. It looks like more red than green today. I'm going to show you a 2-day because semiconductors coming off of their best day in 4 weeks. You can see Taiwan Semi up 5%, AMD up 4%. But I'll give you the look today. We're giving back some of those gains in a lot of these names. And then we got to check out the futures action where we have gold and silver jumping. I'm going to show you silver. I think the chart is a little bit more constructive. Here's a 3-month chart, and you can see it's just kind of breaking out of this negative trend line here and also some horizontal resistance. So we'll have to see what comes of that. But that's aided by a dollar that has been dropping a little bit today. And finally, crypto. We see a lot of red on the board here, but I just want to show you over the last month, we have seen a number of tokens just absolutely on fire. We can see a few of these up about 400%, XLM, Algo, Ripple, and let's just take a look at Ripple here. I was reading this morning's chart report and reminded that we have seen these prices before, but it's been an exceptionally long time. Have to go back to about 2018 or so to see these XRP prices. Brad?
Jared, appreciate it. Thanks so much. It's time now for today's strategy session. With U.S. stocks staging a 27% rally this year, U.S. equity valuations have risen at a faster pace than usual. One notable value investor, however, saying he's ready to buy mega-cap tech stocks. So should you be buying at this level? Joining us now, we've got Kevin Mon, who is the Hanian Walsh CIO. Kevin, great to have you here with us just after the opening bell this morning. So it sounds like some of the buying on the dip mentalities is running strong through your veins right now. Why is that?
Yeah, I would say that all that red and green on the screen, Brad, reminds me that Christmas is coming, and there's likely to be a Santa Claus rally ahead, as I believe that the final 4 weeks of December are going to provide the cherry on top of the 2024 investing Sunday. However, beyond that, although I believe there are growth opportunities ahead in 2025, I think those growth opportunities will be more muted than what we saw in 2024 and 2023. So investors will need to be more selective. Consider all of the record closes that have taken place this year, the lack of downside volatility, and of course, those excessive valuations that are even in that large cap growth technology space. I'm not saying to abandon that space, but perhaps look beyond the Mag 7 to some of those other 493 names that are still trading at attractive valuations and are likely to benefit from some other tailwinds that I see in the markets moving forward.
Kevin, when it comes to some of those, I guess, hesitations amongst investors right now when it comes to valuations, how much of that is overdone maybe at this point? And what is that one thing that you think investors need to keep in mind as we do head into the new year?
Sure. We'll talk about one area. We talked about the Mag 7 and this ongoing theme about the AI revolution. Look, the AI revolution is going to be a very long road, filled with many potholes along the way. So investors will need to realize that investing in the AI revolution is a long game. And all this CapEx spending that's taking place with some of these large cap technology names may not benefit their bottom lines for quarters, if not years to come. The companies realize that, investors need to realize that as well. So perhaps valuation is as an important consideration in those areas. But there are other areas as well beyond that. I think about one sector that's exploding right now, no pun intended, that being aerospace and defense stocks. Clearly, our country needs to upgrade, replenish, and modernize our military capabilities, and those stocks are benefiting from that. And if there is more money spent in those areas going forward, expect those large cap defense contractors to benefit, and some of the smaller cap names like a Kratos Defense that are going to benefit from modernizing our capabilities with technologies such as drones.
What are the sectors you'd be rotating out of right now, Kevin?
I don't know necessarily, Brett, if I'd be rotating out of specific sectors rather than overweighting other sectors. Some sectors that I really like right now, how about banking, financials? I believe at this point in time that regional banking hangover that took place after the regional banking crisis perhaps has been cured. And the antidote for that crisis and that hangover is exactly what led to that crisis in the first place. We see now lower short-term interest rates, declining treasury bond prices, and now the prospects for more financial regulations dwindling, which could lead to more M&A activity down the road. So perhaps some of those beaten up regional banking stocks that don't have large commercial real estate exposure and also strong balance sheets are worthy of consideration. Aerospace and defense, another great area to move into. I love the energy play, Brad, that's associated with the AI revolution. So look at those REITs, the data centers, and then the cooling solutions that are so desperately needed by those data centers. There are so many growth opportunities ahead, but we need to be selective, and it's not going to be like the last 2 years when you could just throw a dart and anything in the S&P 500 was going higher, led by the Mag 7. Now we're going to need to be a lot more selective, I believe, in the new year. And then we haven't even spoken about the Fed yet in terms of what they may or may not do in the month of December.
Kevin, you mentioned M&A, and I'm just curious, just taking a step back more broadly speaking, really just across sectors, how big of a catalyst do you see that being in the new year?
Tremendous. I believe that the opportunities that exist in MA, not just in terms of regional banks, but also in terms of smaller cap biotech companies, are going to present investors with tremendous potential growth opportunities. Look at biotech right now in the state of healthcare in our country. Most large cap pharmaceutical companies are being pressured to lower their drug prices. They also have a lot of large revenue producing drugs coming off a patent and being subject to generic pricing. Where are they going to turn, Shawna, to replace all that lost revenue potential? Well, I believe they're going to have to be acquisitive, and they're going to look to buy those innovative healthcare solutions that the small cap biotech companies are providing, whether it's gene editing, gene splicing, antibody treatments. We could all name the various innovative therapies that are being developed. Look for more M&A activity there and also on the banking front, and that could even extend into other areas as well.
Kevin Mon, thanks so much for your time. Thanks so much for taking the time to join us here.
My pleasure. Have a great day.
It's time now for a chart of the day. We want to send it over to Madison Mills for a closer look at the record longs on U.S. stocks. Maddie.
That's right, Shauna. Investors thrown in the towel when it comes into their shorts on the S&P 500. Take a look at this chart behind me here. You can see the white line indicating the S&P 500, and then you've got the blue line indicating futures contracts on the S&P nearing record highs. The previous record high here back in 2019, and that bull market run heading into the big drop off, of course, we saw heading into the pandemic in 2020. So some context behind this current record high. This is the fourth consecutive week of all-time highs for this bullish positioning on the S&P 500. On the flip side, the team over at Citi that pulled up this chart here, Chris Montague and his team, indicating that this is not the case globally. We're seeing record outflows of European equities at the same time, but the flows into U.S. stocks are so significant right now that globally we are still on track for a record month of ETF inflows for the month of November, specifically for equities. And again, that is being driven by this bullish positioning specifically on U.S. stocks. So what is necessarily going to drive the rally moving forward? That's going to be the big question here. This is coming in the context of optimism, of course, on the Trump trade following that AI rally, but some questions remain about what any sort of tit for tat to come from pending tariffs could look like moving forward, any geopolitical tensions that could bubble over, any stall to the AI rally, and of course unknown unknowns that I certainly don't know about to pull up right now. But those are the risks to this positioning moving forward. But of course, it seems investors are getting excited about this bull market continuing into the new year, guys.
All right, Maddie, thanks so much. And coming up on the other side of the short break, we're going to be talking to a Tesla analyst who sees major growth ahead for the automaker. Stay tuned.
The world changed. That's how Craig Irwin of Roth MKM kicked off his latest Tesla note, upgrading the stock to a buy, raising his price target to $380. We want to bring in Craig right now, joining us now. Craig, I got to tell you, and be honest, this note pretty much caught me by surprise given our past conversations. So lay out this bull case for me and why you see Tesla or the catalyst that you see ahead for Tesla stock.
Yeah, we're always reevaluating, always looking at our assumptions. And you know what? The world did change. So this quarter, I think, is going to be the last quarter where we see a relative weakness for Tesla. I don't think the analyst pool listened all that carefully to the CFO's commentary around margins, his guidance around margins. We think that came from a drop in battery prices that helped them last quarter. Now we have to factor in the election. So I think the pool of enthusiasts basically doubled, right? I mean, you may have some extreme liberals that want to get rid of their Teslas, but I think a lot of people are looking at Tesla going, wow, Musk's a pretty cool guy. Let's go check this thing out. And I think you have a reacceleration of sales in North America. And I think you see Tesla's market share start to rise back above 50% pretty quickly. So that means we have positive earnings revisions out of the sell side coming out of this quarter. They haven't had that for close to 2 years now. And then, this is an abundant list of catalysts on the positive side. On the negative side, there's really not much. The only thing you can do is point to the relative valuation versus the rest of the automotive industry. And that doesn't give them credit for what they're doing on AI and robotics and obviously FSD and the cyber taxi or ADAS. So, when we step back and reassess, the catalysts are there for this to continue probably for the next couple of years. And, that means the right rating here is buy.
What type of new sales realization do you believe would be applicable to Tesla if we were to see the rollback of some of the incentives for purchasing electric vehicles?
Yeah, so it's widely expected now that the Trump administration will roll back the $7,500 a car. Now, we've already seen the mainline automotive OEMs retreating from the EV market. Many of them have been losing too much money. They had badly positioned vehicles. We're developing vehicles for the wrong area of the market, things that were far too expensive or not practical for what consumers really want. I think that retreat continues to happen, obviously accelerate, without the subsidies there, because those are heavily subsidy dependent. I think Tesla probably will put through positive price instead of negative price. So, that's another U-turn in the stock to offset that $7,500 credit. They've shown that they can do that. And, that means that, we'll see the market concentrate back to Tesla. And I think, EVs are an awesome product. I drove an EV myself for a couple of years. There's a far greater implementation of technology there. I think consumers, that like technology, like EVs, and we will see a pool continue to grow in North America. The total growth rate might not be what the total market growth rate would have been, but I think Tesla gains market share and probably does have a pretty attractive growth rate. I think their 20% guide for this coming year is looking a lot more achievable.
Craig, you just perfectly described, though, what the mindset for some of the early movers was, and that I was in an EV for a few years and then perhaps went back over into a standard combustion engine or leveled up and got one of the perhaps super luxurious EVs and enjoying that experience. But for some of those newcomers, what's going to be the new selling point in the technology? It is, and how does that kind of translate through to the Tesla narrative in the story? Is it artificial intelligence? Is it cutting down some of the costs that you would have to see on insurance premiums because maybe there's more data that you can tell your insurer about I'm a safe driver. I've got an EV and it's got all this data that says that.
Yeah, I mean, it's not just like the original sort of early adopters, right? People that are saying, it's green for the environment and, it's economically sensible. I'll save money. No, I mean, I think if you look at the fact that these vehicles are incredibly quiet, they tend to have better sound systems. They tend to have better overall, control logistics than a lot of combustion vehicles at the same price points. I think these vehicles are actually pretty compelling on sort of the soft attributes. Then you look at the impact of Trump, right? That Musk's passionate and authentic support of President Trump. Trump's out there saying, that there's going to be, I guess many of us are looking for an AI czar. The cyber taxi, robo taxi being, at the forefront. A lot of this, I think, will be given strong positive support in the Trump administration. So, we do have the majority of the country Enthusiastically supporting what President Trump wants to do. Obviously, Musk is a huge supporter. I see that as nothing but a positive and nothing that's going to drive more people. That's not going to do anything but drive more people into the Tesla dealerships to kick the tires and say, "Oh, this is pretty cool." So, growth is going to accelerate from here. I'm confident in that.
Greg, how big of an uptick do you think? I guess as we are trying to quantify just exactly what this means and getting more people, I guess what portion of the population maybe wasn't buying a Tesla that now you're viewing as, hey, they actually are more likely to take a look?
I've always held the view that, the hunters and fishermen of America, right, the people that you think of sort of on the conservative end of the scale, have always been passionate defenders of environmental responsibility, clean environment, keep those, coal plants, away from my fishing holes. I want no trash in the area where I go hunting. I think there's a lot of commonality between people on the one extreme versus people that might be, on the other end of the equation. So, it's probably about equal, but we don't have any quantitative data. The next question is, do we see a spike in orders, given the sort of very significant ramp, I think, in enthusiasm around Musk and the Republican Party? That's too early to calibrate. I mean, it's possible we actually see a spike in orders for the January quarter, which would be exciting. And, that's something to watch for very closely.
All right, I tend to keep eyes on. Craig, thanks so much for taking the time. Appreciate it.
Thank you.
All your markets action straight ahead. Stay tuned. You're watching Morning Brief.
You're watching Morning Brief, brought to you by Invesco. We've got a bonus ticker for you this morning. AT&T shares on the move to the upside on stronger than expected outlook for the new year for 2025 and beyond. The telecom giant announcing that at its investor day here later on today that it's announcing billions of dollars in share buybacks. This includes $10 billion by the end of 2026 with an additional $10 billion in 2027 pending board authorization. I was going through this release, and Brad, I know you had the chance to speak with one of the executives about the news here this morning, but clearly just the momentum of the 5G business, of the fiber services business, clearly paying off here for AT&T.
Yeah, some major announcements. Just had to hop on the phone here with the CFO, who we've had on Yahoo Finance before. And, you really get some insights into how this company now and the leadership is thinking about this long-term plan and really showing some of the investments that they're not only making in the network and connectivity, but also in the business. And this is perhaps some of the most comprehensive outlook that we've seen in recent years here. 3 years, long-term guidance, multi-year guidance around some of the key events and earnings. And then additionally, trying to make it a little easier for investors to look through some of the EPS targets that they had put out, which for this year actually reflects an increase at guidance at the midpoint compared to what the street was anticipating for 2024 here, and also backing out some of the DirecTV investments. Of course, TPG is the deal that they're waiting for to finalize there. And so removing that really kind of gives some clarity as to how they're thinking about EPS and continued growth on a forward years basis from here.
All right, well, don't miss Yahoo Finance's conversation with AT&T CEO John Stankey. That's on Market Domination Overtime tomorrow, December 4th at 4 p.m. Eastern Time. Much more ahead. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get to the three catalysts that we're watching this hour.
First up, October JOLTS data crossing the wire, offering us the latest read on the labor market ahead of that critical jobs report this week. We'll get you those numbers.
Plus, after the ouster of Intel CEO Pat Gelsinger, we will take a look at what's behind shakeups in the C-suite this year.
And we'll bring you the latest read on the state of the consumer with fresh data from the start of the holiday shopping season.
Some breaking economic data crossing the wire right now. We're taking a look at job openings actually coming in higher than expected. It looks like right around 7.74 million. The expectation was for just around 7.51 million. We did see a revision to the prior reading that we had out. That was 7.4 million. That was now revised to 7.37 million. So a bit lower there than what we had on the previous reading. And remember, when we take a look at what we are coming off of from that last reading in October, which was the September number, we had September job openings falling to the lowest level that we had seen since at least January of 2021. So we are seeing a revision there even further to the downside for that last reading. But again, for this current reading that we are getting for the latest month here, we are getting 7.74 million. We take a look, compare that to what the survey was expecting at 7.52 million. We are seeing a bit of an upside surprise. So again, this calls into question just in terms of the health of the labor market, what exactly we are seeing, some of those trend lines there, the fact that we did see job openings rising there to 7.74 million, Maddie.
It's interesting taking a look under the hood too. It looks like hires were little changed over the month. As you mentioned, total separations also little changed, and quits rate also little changed, but we did see a bit of an increase. I want to pull up this number. The total number of separations in the month was little changed, but was down over the course of the year. So if you take a look at the number of people who were leaving their jobs this time a year ago, it was perhaps a little bit higher previously. And it's interesting to take a look at that separations rate just as an indication of how much faith people are feeling in the broader economy here. It does look like, if we take a look at the market here, the S&P flipping to the downside, but we've got the Nasdaq up about 0.1% on the back of this data, which we will continue to cover here. Let's get to the market's reaction to the latest jobs data with Noel Coram, the Senior Portfolio Manager at Agile Investment Management. Noel, great to have you on here. What's your reaction?
Yeah, so we have to take a step back and think about the trend, right? We've seen a lot of noise in the trend recently, but overall, we still don't see a lot of major cracks in the economy. So we have to watch that. We don't really think it changes the Fed and their kind of renormalization of rates here, but we will be focusing on the trend and kind of looking for some stability in that trend, right? We still think Friday is going to be very important, but it's not ultimately going to change too much for the Fed for the rest of this year.
So what do you, I guess, then what is your expectation? That they cut 25 and pretty much stay the course just in terms of the messaging here for the markets?
Exactly. And then maybe into next year, we wouldn't be surprised to see them pause and kind of wait to see how the first 100 days go. Again, they're not on a cutting cycle over the long term because growth is relatively still decent. We do need to pay attention to the jobs and the consumer at the end of the day, but we're looking more so along a trend, and that's exactly what the Fed's going to be looking at as well.
Well, I guess I'm curious just from your perspective, and there's been so much debate about what the real focus for the Fed is now, whether or not it's the jobs market versus inflation, now that we do have the risk of tariffs being introduced, the risk of reflation. On the flip side, we are seeing some trends that are at least worth watching within the labor market. What is more important, or is there one that's more important than the other to you?
I'd say from a market perspective, the focus is definitely more on the job side and potential downturn in the economic data. Tariffs are going to be interesting. Undisciplined spending, if we see that next year, that'll be interesting. And I think the Fed cares about it all. They do have a dual mandate, but the market's definitely putting more weight, especially as we close out the year on the jobs data. And we have seen inflation data controlled, right? So that's what's turning the focus to the jobs market.
How strong can we expect the non-farm payrolls print looking like given this JOLTS data?
It is, market participants expect around just over 200 for this past month. And so that's what we'll be watching for to see if there's any holes there, looking for stability again in the trend because we have had a lot of noise there. I think it will be interesting for the trend longer term, But does it change much for the Fed? We still think they go in 25 basis point cut. And then, of course, next year, it's really going to be starting to look at how the economy is impacted over the long term, given the first 100 days of the new administration.
Well, what happens? Let's play devil's advocate here and say that the Fed actually doesn't cut by 25 basis points. We've had a number of guests coming on the show, maybe arguing that it could make sense to pause at this point. What do you think the market's reaction will be?
That's definitely going to be interesting. I think the market probably initially see a little bit a pop in yields higher. But over the long term, I think it doesn't matter too much. It's going to be about the trend in the data. So they could say, hey, we're going to pull back, see how the data plays out from here. The credibility of the Fed still stands. The trend is ultimately what's going to drive what the decision that the Fed's making. So, of course, we have to bring it back to jobs. And if we do have a strong print, you could maybe see that. But I think still they want to renormalize, and they've kind of communicated that over the past several weeks. They want to renormalize the rate, and it's more so about that and getting it in a comfortable spot.
So taking that even a step further, when we get the next dot plot, how much weight should we put into the summary of economic projections, given the amount of unknowns right now, especially with an incoming administration that's going to have an impact as well?
Of course. And even Powell will tell you this, don't put a whole bunch of weight on that particular dot plot, right? These are just economic projections. It really comes down to the data, and that's what we have to watch. We always say at Agile, we're not very good. No one is, right, at predicting the future, but you have to know where to throw the ball if you see certain trends play out. So watching the data is going to be important here, and looking into 2025, the first 100 days, what the new administration's doing is all going to be a factor here.
All right, Noelle, thanks so much for taking the time to join us here this morning. Coming up, the year of leadership shakeups. What's behind the ousting of some of America's biggest CEOs? We've got that for you coming up next on Catalyst. And recapping the numbers here for the JOLTS data that we just got out this morning. We know the labor market, the data that we will be getting on Friday, so critical in terms of some of the movement that we could be seeing coming up here in the coming days. Job openings rising for the latest reading that we did get to 7.74 million. That was versus the estimate of 7.51 million. When you take a look at that quit rate, 3.32 million people quitting their job in October. That quit rate right around 2.1%. Layoffs and discharges, that was at 1% versus a prior reading of 1.1%. So slight decline, if you want to call it that, but essentially pretty much in line from that last reading that we did get. But that overall number ticking up to 7.74 million. We'll be right back.
It's time now for our trending tickers. We're taking a look at BlackRock buying private credit manager HPS Investment Partners in a $12 billion all-stock deal. This is BlackRock's third major acquisition this year and indicative of a broader push into private markets, not just at BlackRock, but also in the broader industry here. This deal is expected to raise BlackRock's private market assets under management and management fees by 40% and 35% respectively. So certainly a big boon for them moving forward. And again, this is that third acquisition this year, so indicative of their broader push into private credit as we've continued to see success in some other public private credit companies this year as well.
Yeah, and this very much solidifies, I think, BlackRock's stance and role within the private credit market. It makes, with this acquisition, it would make them or have them become one of the top 5 private credit firms here with about $220 billion in assets. That room to grow, like you were just talking about, clearly a priority here for BlackRock. I also thought it was interesting in some of the commentary that we have been getting from Larry Fink, the CEO of BlackRock, here on the heels of this, saying that HPS was the only one in this fast-growing private credit industry that they really considered for a potential acquisition. So that really, I think, just speaks to the fact that they think HPS, the strategy there, what that signals here going forward, the growth opportunity was very much of interest specifically here for BlackRock rather than just broader interest within the private credit market, which I think is an important distinction here. And as we talk about the transaction here, it is expected to be completed middle of next year, of course, pending that regulatory approval. But we are seeing some excitement, I think, from the street this morning in terms of what this could mean for the private credit market, how big of a deal this is, and what this signals about BlackRock's strategy here going forward. A record number of CEOs leaving their positions this year, more than 1,800 departures as of the end of October. That's according to the latest data out from Challenger, Gray, and Christmas. Some of the biggest leadership changes happening this week at Intel and Stellantis, but they're far from alone. Other major shakeups this year include CVS, Nike, and Boeing. Joining us now, we want to bring in Olaf Groth. He is a professional faculty for foresight and strategy at UC Berkeley. And Olaf, it's great to have you here on Yahoo Finance. Thanks so much for taking the time. I think the big question here is there a common thread from your view in terms of what's behind a lot of these departures?
Yeah, thanks for having me. Well, obviously, each one of these cases has its own very own pathology, but there are some common threads. So all of these companies are trying to make some fairly heavy pivots amidst some very dramatic headwinds, and they're not making these pivots fast enough for the markets to see the potential for growth, right? For Starbucks and Nike, it's the new physical digital balance. For Stellantis, it's the new model lineup amidst electrification. For Moderna, it's the pivot toward RSV and some other drugs not happening fast enough. And for Intel, clearly, it's the era of cognitive computing, as it were, driven by artificial intelligence. They're making these pivots amidst very heavy trends and forces that are disrupting the industries, right? Think about, obviously, electrification, think about geopolitics, think about inflation, changing consumer tastes, plus heavy competition on top of that. And these leaders are trying to cut their way back to health in terms of budget cuts and layoffs, very substantial layoffs. But of course, you can't shrink yourself to growth. Now, Intel is a special case, but that's the pathology I see across.
So is this about executive performance in those individual cases you mentioned, or is it stock performance? And to what extent do those individuals have control over that?
Well, and that's the key question. Amidst all these headwinds and global trends, it's very, very hard to be a chief executive and to single-handedly steer the ship toward higher growth. And so I don't necessarily think that it's all in the executive capability. It's simply that the organizational capacity for change management, for uncertainty management, for executive foresight, and for agility in making those pivots is simply not there. And they're being caught off guard by some of these things. You could argue they shouldn't be, because some of them, like geopolitics and China and climate change and electrification, have been coming for a long time. But organizations change very slowly.
Is this good news? I mean, this trend of replacing CEOs, does it typically help the stock? Could it hurt the stock? Because we have seen mixed reaction from the street following some of the oustings.
Well, I think medium term, this is not a bad development, right? I think these are wake-up calls. I think letting a CEO go puts a stake in the ground that dramatic change is needed, whether it was their fault or not. And so I think, cleaning house, as it were, revisiting strategies, either accelerating them or slowing existing strategies down may not be a bad thing. So as a wake-up call, this could in fact lead to pivots that are better for growth, and the markets should like that.
To that end, though, these CEOs kind of have a quarterly re-election, if you will, based on the stock performance after their earnings calls. Do you see that part of this, the idea that the stock performance is a key determining factor of executive presence, as a tailwind or headwind for individual CEOs?
Most definitely, and I think it's a headwind, clearly, because the markets are impatient, especially when it comes to Intel, right? The expectation that Intel is going to show dramatic growth in light of artificial intelligence and all the hype and growth that they're seeing in competitors like NVIDIA and AMD and certainly Foxconn on the manufacturing side. All of that is, of course, a headwind for a CEO who has to first make a dramatic turnaround for a very large ocean liner like Intel. And so these very short-term market expectations, amidst all this dramatic capital expenditure, especially in the chip industry, are making that job very tough.
Olaf, I'm curious what you make of these golden parachutes. And I bring that up because it's been reported that the golden parachute here for Gelsinger can be anywhere from $10 up to $12 million. There often, sometimes, or many times has been some backlash just surrounding this and surrounding how big some of these payouts are. Is there a strategy, or what is the strategy, do you think, just in offering these? And is that something that maybe is going to shift given the dramatic rise that we have seen in some of these oustings?
Yeah, I think you're seeing these amounts because the job at the top is ever more lonely than ever before, and it's ever tougher, as it were. And these trends and these dramatic disruptions in global markets aren't going to go away, especially now with tariffs coming. And so I think it is commensurate with the risks that these CEOs are facing. Now, once you get into the multiple dozens, if not hundreds of millions of dollars, I think we have a problem because, the people that are getting laid off are watching this and are saying, wait a minute, my chief didn't do a good job. I'm losing my job. I'm not getting a juicy package. And that is in turn going to diminish morale, both inside the company, but also amidst the public. So I do think boards need to watch very carefully that they need to be measured about just how much that package entails.
How much does a rate cutting cycle from the Fed change this dynamic? If money does become cheaper, then is it a party again for CEOs?
Well, I wouldn't call it a party, but I will say that it will probably help CEOs because a lot of these pivots are very capital intensive. When you're looking at Intel, for instance, right? The government giving it whatever it was, $7.6 billion, and it's spending multiples of that on these new fabs, as well as manufacturing technology enhancements that are very, very tough and very complex and very capital intensive. And so cheaper capital is certainly going to help. The risk that I see longer term is that will lead to some, frankly, tricky spending and maybe overspending because money could get too cheap again. And that could get these companies back into a hole. When you look at AI, for instance, right, we still need to prove greater ROI downstream from all of these business models deploying ROI to justify all the expenditures in expensive GPUs and other chipsets upstream. So cheap money has both advantages short term, but could also have disadvantages medium term.
Olaf, looking ahead to 2025, it sounds like maybe this is a trend that is going to stick. I guess what should investors or shareholders really keep in mind as they look ahead to next year for some of these underperforming companies?
So definitely keep in mind the impact of the tariffs that are coming. I think the Trump administration will use those very quickly, very speedily, and very harshly to stake out a position vis-a-vis other global competitors and partners. So certainly the impact of tariffs, whether some of these companies are going to be able to absorb them as they import into the United States, or as they have a backlash from competitors and partners abroad. Against tariffs that the U.S. issues, there will be a dance, and so understanding what that will be is paramount. And then, of course, energy, the question of energy, because especially in semiconductors, compute power, and artificial intelligence, the energy question is paramount. And keep an eye on employment, right? Like I said, you can't shrink yourself to growth. And the cost of firing and then rehiring is also non-negligible.
All right, Olaf, thanks so much. Appreciate it.
My pleasure.
Sticking with CEO departures, the search for a new chief executive at Stellantis is well underway, according to the car maker, after Carlos Tavares abruptly resigned over the weekend. As for the next CEO, our guest says the path ahead is actually easy. Joining us to discuss, we've got David Underkoffler, Autolist editor-in-chief. David, what does the next CEO have to do here?
Yeah, like I said, it could be potentially very easy. You need to make 3 phone calls right away. You need to apologize to the UAW. You need to call and apologize to your suppliers, and you need to call and apologize to your dealers. Tavares in 2024 managed to alienate all 3 of those groups to a large degree. I mean, these groups are very angry with him and with the company and with Stellantis' performance. And that was because of how Tavares this year sort of reacted to a post-pandemic auto market, right? There were fat and happy days during the pandemic for all automakers, including Stellantis. They had double-digit profit margins. And the problem was that Stellantis and Tavares conflated what was happening then with what was going to happen through the rest of the decade. So when those market conditions started changing this year, when money got more expensive, inflation's higher, sales started falling, in order to protect these really high margins that Tavares had promised, he sort of went after all 3 of those groups, and it really got messy and got him ultimately pushed out of the job.
So what needs to happen then at this point to stabilize the U.S. operations? And I guess when you think about the new CEO, what do you think that search process is going to look like?
Yeah, so to stabilize things, I think, first you have to tell investors, look, double-digit profit margins are not going to happen right now, especially in this era of electrification. That was a pandemic era phenomenon. Now the inventory levels have stabilized, and you're seeing dealers are really clamoring for more incentives, right? There's a huge stockpile of Stellantis vehicles sitting on dealer lots. You've got to sit down with dealers and work out how are you going to get those sold so everybody remains happy. But I think everyone just needs to sort of reevaluate their expectations in terms of profit margins moving forward.
And what do you think will be the bigger drag on profit margins for some of these car makers? The impact of a policy like tariffs or the rolling back of something like EV tax credits?
Ooh, that's a really good question. I think as it relates to Stellantis, look, they don't really have many EVs right now. So they're kind of behind the ball in terms of relative to other automakers. So potentially, if there's a hit to EV tax credits, you can't affect what Stellantis isn't offering right now. In terms of tariffs, that could be a big one. Stellantis has a lot of manufacturing footprint in Mexico, particularly some in Canada. So all automakers are certainly watching this. But I think it would be tariffs over changing the EV tax credit specifically to Stellantis that they're looking out for.
What about Ford and GM, though, just given their exposure to EVs, especially GM? I guess how big of a headwind do you see the rolling back of the EV tax credits to them and their ability to compete with Tesla?
Yeah, it's not going to make things any easier. I think one key difference between Ford and General Motors is that General Motors has said by the end of this year, its EVs, by a specific metric, will be profitable. And that's sort of a pretty big milestone. They're only the second automaker to hit that milestone behind Tesla. Ford is lagging behind, but I don't think that's specific to Ford. All other automakers right now are really struggling with massive costs, R&D costs, in the sort of the pivot to electrification. The last thing any of them need is more headwinds in terms of tariffs or reducing these tax credits. I do think they're probably taking a long view, right? This potentially is, the Trump administration sort of for whatever they do. There will be a lot of battles in the next 4 years. California and Gavin Newsom have made it clear that they're not going to let any of these tax credits go without a fight. And then, potentially it's only 4 years. And I know that that's not a short period of time, but these automakers are likely looking global in terms of how they are orienting, how they're spending their money in R&D. And globally, there is still, the winds of EV are growing and that momentum is growing. And they're probably looking at, okay, let's get through these 4 years and potentially there are more changes back into the pro-EV direction after this Trump administration.
David, ending a bit closer to where we started on CEO shakeups, how likely do you think it is that we could see a push for a new CEO at Ford?
I don't think, if I'm Jim Farley, I don't think that Tavares being pushed out, it causes me to lose sleep. I mean, this is a Stellantis problem, and it was a Stellantis problem that Tavares himself and his C-suite created for themselves. Farley, certainly, like I said, Ford's Blue division is facing steep losses with its EVs, but that's sort of par for the course. I know, going back to GM, that probably has the sting to see your crosstown rival start to make, say they're going to be profitable with EVs. But GM is the exception, not the rule. Ford and all of their automakers are spending huge amounts of money for EVs. So I don't think that puts Farley in the hot seat any more than any other CEO right now. As your previous guest was talking about, this is a really tricky pivot for the head of any of these automakers to sort of navigate through these very expensive EV investments, and move forward with that.
Yeah, tough time to be a CEO, I guess, David. Thank you so much for joining us. I appreciate it.
Thank you so much.
We'll have all your markets action ahead right here on Yahoo Finance, so stick around for more. You're watching Catalysts.
Consumers spending big this holiday season. There's new data out from Adobe Analytics showing that Americans spent a record $13.3 billion on Cyber Monday. That's coming off a record Black Friday. That's all $10.8 billion spent online. Here with more, we want to bring in Taylor Schreiner from Adobe. Taylor, it's great to have you here on Yahoo Finance. Just talk to me just about what this tells us about consumer sentiment and maybe more broadly what this signals about some of the shopping patterns that we could see heading into the new year.
Well, it's really good news for how consumers are thinking about spending their money. Seeing new record-breaking sales, 13 billion. This means consumers are back. They are online. They're looking online for good deals and good base prices. Over the past 2 years, we've seen prices come down online for the basket of goods that people normally buy in the online space. So people are expecting to get good prices online. They're seeing really great deals over the Black Friday, Cyber Monday holiday period, and then headed into this shopping season as we ramp up toward Christmas and the end of the year, we're going to see a really quick level of shopping as people have only about 3 weeks to get those presents bought and shipped and put under the tree.
I want to stick on this cautious consumer because it sounds like good news when I hear your headline there, but we've continued to hear from retailers themselves that there's this choosier consumer. What can you tell us about where we saw individuals making the choice to splurge a little versus save a little?
Well, we have some really interesting data on that front. So first of all, I think part of the move to the online space has to do with choosy consumers looking for opportunities to find lower prices and find the goods that they're looking for. But two other things really stand out to me on that front. One, when we look at our data, we look at the top 25% prices, the higher end items, and we see customers making an investment there. So this is not consumers just coming and looking for the cheapest thing that they can get or the very best deal. They're actually picking out items that are maybe on the higher end, they may be on discount, but are on the higher end and making those purchases. And they're also starting to use other tools to try and make these decisions and pick out the things that they're looking for. Specifically, we've seen about a 20x increase in the use of AI assistants and AI agents to try and help consumers do some shopping and pick out the things that really work for the folks that they want to buy for. And that, I think, is how a lot of their choosiness and selectivity is manifesting in the marketplace.
Taylor, what are some of the trends you saw just about buy now, pay later? We certainly have covered the rising impact and then the rising use of buy now, pay later, to put it simply. I'm curious what you think or what investors should be gleaning from that in terms of how consumers are set up at this point.
Buy now, pay later in our data had a rocket ride over the past several years, and it has come now into a sort of single digit reasonable growth rate in terms of how people are using it. People are looking across a variety of financial instruments to make purchases, and BNPL is clearly a part of that. It's clearly a growing part of that, but it is not rocketing off of the tiny base that it was on previously. So, we're seeing younger consumers especially look to use buy now, pay later to make big purchases, but honestly, a variety of purchases as they try and balance between how they think about their credit card debt, how they think about their checking account, and then how to manage specific purchases around that in a shorter time frame.
For anyone who maybe was working yesterday, busy, didn't have time to get the Cyber Monday deals in, are there still deals available for shoppers?
Gosh, I hope so, because I was working yesterday and I certainly don't have everything done. Yes, so yesterday we saw the lowest set of the greatest discounts that we'll see for this season. So if you bought a computer or some electronics yesterday, you're likely spending 30% less than you were for that same item maybe at the beginning of October. But there still are a number of other deals out there. You just have to be a little bit more thoughtful about how you're looking for it. You need to keep an eye on your emails. You need to look for the specific items. And some folks, as I said, are going to use some AI assistants to keep an eye out for the specific discounts that they're looking for on particular items.
Yeah, I'm fascinated by that as someone who tried to use ChatGPT for an outfit recommendation. I need your tips because it did not end well, Taylor. Thank you so much for joining us today. We appreciate it.
Thank you.
Well, inboxes were flooded with promotional messages ahead of Black Friday. According to data and marketing automation platform Klaviyo, companies sent 18 billion messages to consumers between Thanksgiving, Thursday, and Cyber Monday. Joining us now to discuss, we've got Andrew Bielecki. He's the CEO of Klaviyo. Andrew, it's great to have you on here. So talk to me just broadly. What was your biggest takeaway about how successful the marketing campaigns were this cycle?
Yeah, it was a great start to the holiday season for the 150,000 businesses using Klaviyo. As you mentioned, 18 billion messages. And most importantly, a trend we've been following for the last few years is consumers are choosing to shop with brands they already know. More than, or just about half of the purchases made by consumers were from businesses they already have relationships with. And so for us, that meant that Klaviyo brands generated over $3 billion in revenue from those messages. So that's a big uptick from what we've seen the last few years.
Andrew, did you see any sort of difference or gap in performance between some of the smaller companies that you work with versus the larger, maybe better known names at this point?
No, I don't think so. What was interesting, one of the things we noticed on discounting strategy, obviously it's something that comes up a lot around Black Friday and Cyber Monday. It was actually consumers were opting to buy from businesses not based on who gave the biggest discount. So we saw some discounts, 50, 60% off. But actually the best performing messages had discounts that were really only in the 10, 20% range. And so our belief is it was a lot of consumers they knew the brands they wanted to buy from. They maybe had their eye on a product and they were waiting for some sort of sign that it was on sale. And then once they got that message, that was causing them to buy.
Andrew, what's the takeaway then for investors from that? I guess, is that more of a brand loyalty sort of takeaway, just how important that is in remaining engaged with your consumer? Or I guess, what does that then tell us about the strategy of some retailers that are waiting to offer even just 10 to 20% discounts versus those who might be a little bit more aggressive with the 40 to 50% off?
Yeah, well, a recurring story to the holiday season is consumers are going back to businesses they already know. And so, for businesses, it turns out like, hey, personalization, knowing who your customer is. Another trend we saw was the amount of data that consumers were sharing with businesses and brands to get better recommendations. That increased a lot, just even over the amount of surveys filled out, even over the last few days, that increased a lot. So personalized messaging matters. The other big trend that we saw was a lot of brands were using AI to then leverage that data to turn it into more personalized messaging. I think that's really interesting because we think about trust in AI tools, especially when, maybe the year's on the line, biggest day of the year for a lot of brands. They were relying on our AI tools to, one, help them generate creative, either copy or images, but then also optimize those. So we see that as a big sign that personalization really matters. And increasingly, folks are going to rely on, AI tools to help them, match up to consumer preferences.
How much does the platform where these brands are reaching consumers matter, Andrew? I keep seeing small business owners popping up on my TikTok For You page. Is that a strategy that you're finding increasingly successful?
Yeah, I think the story for brands is it's really being about where consumers are. So across social, that can mean TikTok, Instagram. We're finding on the messaging side, increasingly brands they're not just relying on email. They're using text messaging. If they're a larger brand or they have a mobile app, they're using push notifications. And actually, that's driving a lot of incremental revenue. We found businesses that use more than one messaging channel with Klaviyo generated 20% more revenue over the Thanksgiving, Black Friday, Cyber Monday weekend.
Andrew, when it comes to, I guess, your advice for brands or maybe some of the trends that you've noticed on your platform, those brands that are able to maintain that momentum and maintain it pretty steadily, what is the key from your view to that success?
Well, I think we've hit the era of personalization and really automation. We think the modern customer experience is driven by asking your the end consumer, what are they interested in? Using their purchase data, using their browsing data, asking them, what their preferences are, and then pulling that all together to curate an experience for them. Curate that across messaging, across the website, maybe even on social media, so they're seeing, the products and content that's relevant to them. And that's creating these more durable relationships. I think the era of, commerce is kind of one and done. I buy once from a brand. That's kind of giving way to consumers having real brand affinity. If brands can deliver that, sort of more personalized, more tailored experience.
Andrew, let's talk specifically about Klaviyo and the strategy here heading into the new year. You've got a very strong balance sheet. Your cash flow looks very strong and solid at this point. Is M&A in the pipeline? Is M&A in the works? I guess, how do you plan to put some of that money to work?
Yeah. Well, we're a company founded by builders, so we do a lot of building. I guess nothing's off the table. But as we think going forward, Klaviyo started as a kind of the brain of a business, a way to know who your consumers are, and then we got into marketing. And first it was email, and then we expanded that to SMS and mobile. As we look forward, I think there's a lot of other customer experiences that we can help improve, make more personal. So if you think about everything from messaging and marketing to then, how do you make that customer experience or customer service experience really good, or when somebody's on your website or maybe even in a store, how all of those things stitch together. One of the really cool things we're doing now is the product recommendations that we're able to generate with all that data. Those now work across messaging like email or text messages, but also on your website. So I think this true omni-channel experience where a brand is able to literally rearrange the entire experience for every single consumer, that's the future, and we're excited to power that for huge retailers, iconic brands, as well as folks that are just getting started.
Andrew Bialecki, always great to have you. Thanks so much for taking the time, CEO of Klaviyo. Coming up, we're talking holiday shipping logistics. We're talking to the CEO, U.S. CEO of DHL Express. We'll be right back.
It's peak season for shipping and logistics companies. Joining us now to discuss the holiday outlook, we've got DHL Express U.S. CEO Greg Hewitt. Greg, thanks for being here. Talk to me about your outlook for the holiday season. I know you're expecting an increase in volume.
Yeah, good morning, Madison. Thanks for having me. Yes, peak season is upon us, we'll say, with Black Friday and Cyber Monday volumes. We had anticipated about a 40% lift on kind of our average daily volume. And what we've seen with a busy day yesterday is greater than 60% volume lift. So that means consumers here in the US are buying and lots of goods coming in from overseas for delivery.
Greg, have you at all, I guess, shifted your strategy in terms of prepping for that, given the rise of e-commerce, even just given the numbers? We were just talking to the CEO of Klaviyo a few minutes ago, talking about the rise of just online shopping and more broadly based beyond the U.S. I guess, how does that affect your strategy and your cost plans heading into the holiday season?
Well, I think we've become very accustomed to an increase every peak in that 40% range. So this is actually, I'll call it normal for us. What do we need to do? That means we need to make sure we have enough agents on the phone to help with customer service. We need to make sure we've got enough lift in terms of aviation capacity to move things overseas in and out. And we need to have enough couriers and staff in our stations to move the packages and get them delivered on time. So we're pretty good at that. I think we're going to add about 200 people this year here in the US to handle that volume. So it's all about planning and getting started early. And it's nice when your forecasts somewhat align. This is pretty busy, but we were able to handle it yesterday.
And to clarify Shauna's question, are you implementing those surcharges you guys have teased out this season?
We did implement in September a demand surcharge, which applies for capacity and lift in terms of aviation coming in and out, primarily on the US Asia lane, but also on the Europe Asia lane. These are areas where the costs to add, charter flights for short periods of time are quite expensive. And so we look to our customers to help compensate and pay appropriately for that additional lift. If they don't use it or don't need it, we don't add it and the surcharge can change. But as we've seen by the volume, like we expected, it has come and we needed that extra lift. And that's what helps us make sure it's cost effective.
Greg, are you able to meet that demand?
Yes, we've had no issues. For me, the biggest lever that I can pull is weekend work. So as the volume goes up and aligns with our strategy, my team is ready. Our couriers are prepared to work on weekends and overtime if necessary, along with the extra staff we brought on. We'll make sure every package is delivered before Christmas and then also before the busy Chinese New Year.
Greg, you know I can't let you go without talking about Trump's tariff policies. I know that you are a beneficiary of globalization, shipping between nations, but if true protectionist policy is put in place in the U.S., how much of a headwind could that be for you?
Well, I think there's two things to that. One is we need to make sure we staff accordingly in our clearance area and work closely with Customs Border Protection to make sure we can remain compliant and apply duties, taxes, and tariffs appropriately to keep commerce moving. The question of what it will do to demand, I think last time when the tariffs came in, everybody expected a real shutdown on the China lane. And the reality is China is incredibly important to not just the US economy, but the global economy. And although companies found ways to do omni-shoring where they were looking at other markets to produce goods, things like nearshoring in Mexico, for example, here in the US, we would expect a little bit more of that. We might expect some price increases that go along with passing those costs on. But the number one thing for us is to make sure that we're able to adapt and make sure that we keep things flowing and keep that. Consumers' demands for products are global in nature. So they'll find a market where they can be produced, and we'll be there to move them inbound to the US compliantly.
Greg, what about just your rivals and competitors within the space? Obviously, a lot of people think about UPS, FedEx, more focused on Amazon, just how big of a disruptor they are going to be, obviously ways to partner as well going forward. How are you thinking about just the increase in competition and maybe how that's shaping your strategy at DHL?
Well, I think we've always faced stiff competition, particularly here in the US, which is kind of the home base for for Fed and for UPS. I think we're three big, very strong companies that have different markets and different areas where we show strength. We're very proud of being the leader in time-definite international transits around the world, and that's what we focus on. While maybe our competitors are a little bit more focused on the domestic market here in the US. As for Amazon, they've come in and they've definitely done some, I guess, become a logistics player within a market like the United States. They're an important customer of ours. So for us, we like to work closely with them, make sure that their strategy is linked to their global strategy, and we help them on the global side while they build out their domestic structure.
All right, Greg, great to have you. Greg Hewitt of DHL Express. Thanks so much for taking the time to join us.
Thank you both.
Keep it right here on Yahoo Finance. We've got much more of your market action ahead. You're watching Catalyst.
As Elon Musk prepares to lead President-elect Trump's efficiency push, he's taken aim at everything from the Pentagon's budget to daylight saving time and posts on social media. But how much can Musk actually do in Washington? Sultan Megji has some experience with government as the former chief innovation officer at the FDIC, and he joins us now to discuss. Sultan, great to have you on here. I know you're going to walk us through a few different inefficiencies you noticed in your time in government here, but what is the single biggest one that you think Musk could actually take on?
That's a great question. Fundamentally getting the people in the government on their toes is going to be the biggest thing. Everything from procurement to standard operating processes, these all predate the existence of the fax machine. So just getting people to wake up and realize that we don't have to do things the same way they were done before, when most of the people listening to this were born, will be the biggest thing, frankly.
How confident are you that that's attainable, that's going to be something that can be accomplished and accomplished in a timely fashion?
Yeah, this is kind of a multi-part answer. The short version is I'm not sure how much he's going to be able to get done because it's not a government agency. And to create a government agency, you have to get Congress to sign off on it and then has to follow the rules that the U.S. government has. And that's a lot of work. And we know that, tax policy is going to be front and center as well tariffs on the front end of the Trump administration. They really only have about 18 months before the next set of elections and getting an entire agency created that has the legal authority to tell other agencies how to operate, how to hire, how to buy things. That's a tall order, even with the control of both houses of Congress, although it is a fairly thin margin there.
How much sort of AI goodness do you anticipate Musk and Ramaswamy being able to infuse into government, given that they're obviously huge proponents of the technology?
That's one area where I think there's a tremendous opportunity, and one that doesn't require a lot of legal change. The ability to use artificial intelligence to drive efficiency into human process is something that the government's been doing for a long time. We did it when I was in there. It's been going on for quite a while. The Department of Defense has really been taking the lead on this for decades, but a lot of other agencies are using this. We see it with financial regulators as they look at money laundering and terrorist financing. There's a lot there, and it doesn't require an act of Congress to activate it.
Sultan, I'm curious just to get your perspective on this. For an outsider coming in who doesn't have government experience, many of these appointees, and really across the board, how much of their experience in the private sector, is that an advantage? Is it a disadvantage? I guess, how should we be looking at that?
Well, it's both. I mean, the operating in the private sector, especially if you come from startups and high growth companies, you get things done on a daily basis. It took me over a year to try to get a new hoodie made with a logo on it when I was inside. And so you have to think about the scale of what you're trying to get done and the timing of it. And in some cases you can move quite quickly, but in other cases you can't. And understanding that there are processes, there are legal rules you have to follow in the government that you don't have to follow in the private sector is something that I think will be a bit of a dose of cold water for a lot of the people looking for day 3 of the Trump administration radically altering some operating model of a federal agency.
But I know that you are confident that cuts can be made. And that's interesting given that we've had some conversations with other experts who say there's actually not a ton of wiggle room when you take into account Social Security, Medicare, interest rates, all of those things. So what would your advice be if Trump called you after this segment? What would you say needs to get cut?
First off, I'd be really surprised if President-elect Trump called me. But I would say that this is an important point. Less than 50% of the federal budget is discretionary in any way, and so there is a bunch of stuff that's just preloaded. The thing that has changed over the last few years, and certainly it's more so now than when he was first in office, was that the U.S. government relies on outside contractors far more so than they did 5 years ago, 10 years ago, 30 years ago. And those contracts are much more easily managed than an act of Congress. And so the ability for the US government to tighten the belt on contracts is very high. There's also a high consolidation of number of significant vendors. Microsoft is one of the largest government contractors out of all of them, bigger than big brand names like that do defense work, for example. And so the ability to go in and renegotiate contracts or alter the contract structures is something that's really that I think is far more likely to turn to savings than firing X% of a workforce or something like that.
Switching gears in our final minute here, we know that Elon Musk is pushing for legal action against OpenAI. What do you think is the motivating force behind that?
Well, there are really 3 types of AI companies out there right now. There are enterprise B2B AI companies, and that's exemplified by Microsoft as an example. You have B2C or consumer-facing AI companies like OpenAI and Anthropic that have had less success getting into big enterprises, for a variety of reasons. And then you have kind of the niche AI players that have been around for a while and will continue to be there. Elon Musk, as a former shareholder of OpenAI, was looking, I think, for a lot of that enterprise value, that enterprise, those big multi-billion-dollar contracts, and he currently doesn't have a play in that space. And so my view is he's probably looking for more enterprise revenue on the AI side and trying to alter OpenAI so that it's not a competitor in a few years when he is going to be able to get more enterprise revenue.
Sultan Meghji, always appreciate your time. Thanks so much for joining us here this morning.
Thanks for having me.
That does it for Catalyst, but keep it right here on Yahoo Finance. Wealth is coming up next.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, the S&P 500 coming off of its 54th record close of the year. We're going to talk to a portfolio manager about the 3 areas they see opportunity in right now. And we'll dive into the latest jobs data, JOLTS. Plus, we're going to discuss some of those rising tensions over return to office mandates. And we've also got a deep dive on wealth in America. Who is wealthy and how do people define wealth? And how did the wealthy get where they are today? These are the questions that we're going to get some answers to from a recent Fidelity report. All that and much more during today's show. But first, we take a look at some of the market action. We're just a little over 90 minutes into the start of today's trading activity. Stocks narrowly mixed today here. The S&P 500 and the Nasdaq hit record highs Monday. Joining me now, we've got Sandra Cho, who is the Point Wealth Capital Management CEO and founder. Great to have you here with us this morning. You're closely watching 3 areas to invest right now, and I want to start with energy specifically there. What are some of the picks that you feel most energized about within that sector?
Well, it hasn't had the huge run-up that the overall, AI market has. There are certain names that we're really looking at, like Chevron, Exxon, Clearway, that, really have some valuation potential over there. And, we're looking at some other sectors too. I mean, some names have really been beaten down in, for example, Boeing, Intel. I mean, these names, as we know, have taken a hit. So we're looking at them closely. And then, of course, healthcare. So Intuitive Surgical, long growth one way, been a favorite of ours for quite a while. And we're keeping a close watch there.
I want to come back to some of those beaten down names that you mentioned, and we're taking a look at Boeing on the screen there a moment ago. As you're thinking about what type of opportunity there is and what most notably you would need to see within the fundamentals to improve for these companies for it to really translate into some broader sentiment that kind of sends ripples through the markets.
Sure. Well, as we've heard in the news constantly, there's been problems with quality, safety. So, they had the huge strike, but now that's in the rearview mirror. They can focus on just cleaning things up and just having their process be tight as far as, keeping things clean, making sure there's not the issues that they've had before with, bolts coming off doors and, just safety issues, both in making their products and then also, in the air. I mean, you've got to have confidence and the airlines have to have confidence. Plus, not only that, I mean, you see this huge backlog of orders that need to be filled. So, there are, some production challenges that really they need to just fix. So I do feel that they're on the path to do that. And if they continue that, then, that potentially could be very good for the stock.
You also mentioned healthcare and your picks within healthcare. As you're thinking about some of the changes that that industry is preparing itself for, as we have, of course, in 2025, a changing of, or 2025, after the inauguration, there's going to be a new fleet of folks that are really earmarked to come in and look across healthcare, everything from biotech, even into the insurance businesses. Where are you kind of anticipating some of those changes to impact your own portfolio strategy?
I think one of the most exciting areas right now is that biotech space that you mentioned. I mean, there's innovations that are happening, that were happening before, but now are catalysts and catapulted up. Like, for example, as we know, during COVID, there was just, quite a bit of depression, no matter what the age group, but especially with younger folks. And, it was difficult. And so now with biotech, they're coming up with things like, implants that are as small as a pea, that are minimally invasive, that actually go into your brain and help you rewire to get out of PTSD, depression. These are things that are just revolutionary. And then, going back to intuitive surgical, long growth runway, here you have this company that has invented the Da Vinci system that has been around. It's been there. But, it's being used more and more. And I think people are opening up their minds to robotics-assisted, minimally invasive surgery that could really benefit a lot of people.
And then just lastly, while we have you here, you were mentioning some energy names as well. And I think more broadly about the performance that we've seen of XLE over the course of this year, up still about 11, 12%, but underperforming, obviously, the broader S&P 500. So what are you looking for as the catalyst for that industry?
Just look around at AI. AI is going to take an immense amount of energy. And, from everywhere that you could possibly imagine. You've heard talk about bringing back nuclear plants and developing that, but AI is just going to need a huge amount, and that's got to be powered by the companies that exist right now, and then perhaps new technologies that we have yet to kind of tap into. But energy is not going to be going away, and like you mentioned, it hasn't had this huge run up that some of these, bigger Mag 7 names have really had in the last 2 years.
Sandra, thank you so much for taking the time here with us today. We're going to be tracking all of these picks going into next year. Appreciate it.
Thanks, Brad.
Now time for some of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now on set, we've got my morning brief co-host, Shauna Smith. First up, Shauna, we got to talk about this one that's come across analysts getting bullish on Credo technology after an earnings beat. Bank of America double upgrading to buy from underperform, reflecting the growth in the second half of fiscal 2025 due to the increasing adoption of AI. Barclays, TD Cowen, Needham, and Stifel all lifting their price targets on the stock too. My goodness, a 44% jump here on the day, Shauna.
Yeah, Bank of America still thinks that the stock actually has room to run from the levels that we're seeing the stock trade at here today. Their new price target of $80 a share, showing some upside there. So what has changed? Much of this really being driven by the results that we just got from Credo, the company's CEO calling it the turning point has arrived when he talks about the AI deployments driving that greater than anticipated demand here. We're seeing the massive surge. It's actually the biggest intraday jump that we have seen on record. Maybe not too much of a surprise given the magnitude of the jump that we are seeing today. So yes, we are hearing Vivek Arya coming out from Bank of America, the double upgrade that you just mentioned. You also quickly mentioned Barclays there, now have an overweight rating, a price target of $80 a share. That was up from just $32 a share. The company saying that into the second half of the year, Amazon driving that lion's share of growth, really ramping up AI server deployments across both Trainium 2 and merchants GPUs. So I think it's safe to say that the street was very encouraged by what they saw in these results, by what they are hearing from management on the heels of this quarter, and also just what that tells us about the current demand that we are seeing this quarter. But not only that, what some of those growth numbers could look like into 2025 and how much more room the stock really does have to run.
Absolutely. We're tracking another stock here on the day as well. Kroger here getting dueling calls this morning. An upgrade at Jefferies to buy from hold, and the analyst sees upside regardless of the success of the Albertsons acquisition. You knew that I was going to bring this up with you on the show today, and projects double-digit profits and strong free cash flow for fiscal 2026 to 2028. BMO Capital Markets cutting the stock to market perform from outperform, saying any benefits of a merger with Albertsons already priced in, and that the further upside requires Kroger to get more market share or increase profit expectations. You write about a story a couple times, Shauna, and we're going to call you in on it every single time it comes up.
I'm on the Albertsons Kroger beat. Let's talk about this. The call that really stuck out to me was from Jefferies, right? Because they were bullish just regardless of what happens. And I think that might have been a surprise to some on the street. Yes, many see upside if Albertsons deal goes through, but they actually explored the scenario about what happens if the deal does not go through. And the analysts there making the argument that Kroger would keep $6 billion to $10.5 billion in debt that they did raise for the deal, and likely to put some of that to use, a portion of that at least, for buybacks. They also talked about the uptick that they have seen in foot traffic at Kroger. Obviously, that is a bullish sign here for the company going into the holiday season and into 2025. Also, the fuel business was a standout here for Jefferies. They talked about the fact that the fuel business now is more profitable than it was before the pandemic. They went in to call it a quote-unquote incremental kicker. So that was a call that really stuck out to me. On the flip side, you mentioned the BMO, the downgrade there. It was all about valuation. A lot of that, but just them making the argument that the upside here from the Albertsons Kroger deal closure, if we were to get one, if it were to be approved, that very much has been priced in here. But again, I think the Jefferies call is very interesting, that they are bullish just regardless of what this outcome looks like.
Absolutely. You got some executive changes going to be taking place too. New chief marketing officer and merchant officer going to be coming in, or at least the departure of their existing one in January 2025. So that's something to track. Also here, just lastly, let's rip ahead to UBS, out with a couple of auto calls here. Upgrading BMW to buy from neutral, citing potential for improved cash returns. The firm also downgrading Mercedes-Benz to neutral from buy, citing a likely cap of 6 to 8% on profit margins for 2025 and 2026 as the company works to improve profitability by cutting costs here. You got two big calls on some luxury automakers internationally known.
Yeah, and I also think the divergence here, just in terms of their outlook of how they're viewing BMW versus Mercedes right now, is also very indicative of really some of the trends that are going on here inside the U.S. auto market. But let's stick with these calls. And BMW, a couple of things that UBS raised on this, just saying that it does stand out from many of its peers, and three reasons why. You mentioned the improvement in free cash flow generation on a year-over-year basis. That's something that many of their competitors are actually not seeing. The second catalyst that they see is a potential here for the most generous cash return policy, no longer limited to free cash flow, which I thought was an interesting and important point there from UBS. And also just the fact that they actually view BMW as best positioned here to comply with the EU's CO2 regulation without aggressively pushing some of those margin dilutive EV sales in the region relative to some of its German peers. So even though we are seeing this crackdown, they think BMW has the strategy implemented and very much in place to be able to navigate some of those new CO2 roles that are coming down the pipeline. Because of that, they think that they're amongst the best positioned here within the group.
Just one other note I'll add on this. I mean, this is a year where we've also seen, for the amount of certified pre-owned vehicles really dominating the landscape for used vehicle sales, and you think about how luxury has played into that too, 24% of all CPO certified pre-owned sales for much of this year have really come from those luxury automakers too. So it's not just what new vehicles are you going to put out there and generate new profit margins off of, but how is the inventory that you've already built, developed, and put into market circulating right now, and ultimately perhaps eating into some of the potential demand for vehicles out there right now. Shauna, thanks so much for talking everything from the grocery aisles to the luxury vehicles. And I forget where we started off, but anyway, we had a great conversation. Luxury car maker Jaguar is out with a new concept car, since we're on luxury, the all-electric Jaguar Type 00. And it comes as the company faces mixed reviews over its rebrand. Here with more is Yahoo Finance Autos reporter Pras Subramanian. Pras, it feels like the rebrand is just taking up all of my social media feed, but what about this concept car? What's going on with it?
You know, you guys are just talking about BMW and Mercedes, two of the established luxury brands that are doing reasonably well. But then you have Jaguar. Look, they were doing pretty poorly, unfortunately. The Story brand, a big British icon, cars weren't selling. So what do? They try to reboot this entire situation. And what they did was they showed the new Type 00, which is a very striking fastback design, coupe design, harkening back to the old E-Type, but on a very Art Deco, kind of very forward design. A lot of criticism here. Some people calling it the Barbie Pink Mobile because it came in a pink color too. Although saying they call it the Pink Batmobile, which we have some imagery of that. But so getting a lot of heat there. But look, I think if you're a Jaguar, you need to sort of stand out amongst the crowd. You need to beat the BMWs and Mercedes at their game and go even more upmarket. And I think this is Jaguar's way of saying, hey, we're actually going to go way upmarket. And it's going to be almost to the point of like of being a high concept, more than just an automaker, more of a brand or sort of a design consciousness that you want to have for just anything.
I mean, I'm just looking at the visuals here. It doesn't even look, it looks like an emoji of a Jaguar, but it's going to be out there, I guess, or at least in concept. We'll see how it makes the rounds at CES, potentially. This also comes on the heels of a company rebrand. We mentioned this. This has got people talking, Pros. What are your thoughts? What are you hearing?
You know, that's what happened last week. So they came out with a video that didn't even show a car. It just showed a bunch of models in very avant-garde clothing, sort of standing there and dancing and looking around, and sort of their new take is the new logo that there's copy nothing. I got a lot of heat. Even Elon Musk said, hey, do you guys even sell cars? I think that's sort of the problem, is a lot of the car people were upset about the fact that it seemed too out there. It was even criticized as being woke in some way. But I think Jaguar is sort of, they know they have to sort of break through the mold. This is one way to do it. I don't know if this is the most appropriate way to do it. Maybe seeing more of the cars would have been a better idea. I think, you know, the CEO defended this strategy, saying we have to stand out. We'll get, quote, drowned out if we don't. We shouldn't just turn up like a normal auto brand. He told us the FT. So I think that's the strategy we're seeing it. And look, we're talking about it now. We weren't talking about Jaguar before. I think people talk about, do they even make cars? They do, but now they're actually relevant. Whether that's a good thing or not it remains to be seen.
I would love to see some of the traffic to their website just asking that question, well, where are the cars at? What's the new vehicles along with this rebrand as well, and trying to get, you know, just more information. And from that perspective, maybe it would have moved the dial, or at least, you know, started some demand generation, which is good for marketing. Pros, thanks so much for taking the time here. It was definitely giving some like blue steel type of energy for sure here. Pros, appreciate it. Coming up,
hey,
everyone.
Brad, I'm going to get that car for you. We're going to drive it around.
I'm ready. Pick me up downstairs. Guys, coming up, we're going to break down the latest jobs data and talk about the return to office mandate. Stay tuned. U.S. job openings topped 7.7 million in October, significantly surpassing forecasts and a sign of strength for the labor market. The print comes just days ahead of the November payrolls report, a key data point ahead of the Fed's December meeting, the final for 2024. Joining me now, we've got Elise Gould, who is the senior economist at the Economic Policy Institute. Great to have you here with us. We do know that Economic Policy Institute tends to, as some people have said, lean more left. But as we're thinking about just the state of the labor market right now, how would you kind of encapsulate it coming off of this JOLTS report and then going into some of the other prints that we're going to get tomorrow in ADP private payrolls and then even into the end of the week for the employment situation?
Sure. For data nerds like me, it's a great week. We have a lot of data to look at to assess the state of the economy. And the data is telling a consistent story so far. We have seen significant labor market strength continue throughout this year. So the JOLTS data, as you said, that's the job openings and labor turnover survey that showed that job openings actually ticked up. Quits also ticked up a little bit as hires softened a bit. So on net, I would say it's a very strong economy. We'll see the latest jobs report that will give us the data for November. And the things I'll be looking for are what's happening with wages, what's happening with job growth. We know that the prime age employment to population ratio, the share of the population 25 to 54, continues to be at historic highs, particularly for women. And I'd look to see what will continue there.
What are you tracking most notably with an unemployment rate that has kind of maintained the same level over the past two reports, but of course there is more of a thought process around, okay, what if we do see that tick higher and then what activity we could see on the back of that from the FOMC?
Well, I think the unemployment rate has continued to be pretty low, right? It ticked up a little bit, but it's maintained a fairly low rate over the last few years. And I think that's promising as more people continue to come into the labor force. If that ticks up, that could be a concern about softening. I think that the Federal Reserve will continue to lower rates. That is what the data all indicates. There's no overheating. There continues to be strength, but there's no overheating. And I'm not concerned, particularly when we look at the JOLTS data, about a recession coming. Their layoffs tick down again in October, and that remains low by historical standards.
As we're kind of pairing the labor markets data with inflation and really getting a sense of where there are some cracks that are starting to show up depending upon which cohort you're looking at in the consumer, how do you more broadly kind of pair that with what the projections are for both economic growth but also just avoiding a recession?
Well, I think the interest rates are a key factor there. They need to keep coming down to avoid a recession. We're seeing that, and I believe that the Federal Reserve will continue to act. Inflation has come down considerably in the last couple of years. We know that average wages have been beating inflation for a year and a half now. We also know, another good point we've seen in the last few years in this whole pandemic labor market is a reduction in inequality. I'd like to see that continue in the coming months and years.
And so that in mind, we've heard from a lot of economists calling for essentially one cut every quarter next year. Do you think that's the right strategy for the Fed? And what would that ultimately show you about the broader employment situation as they're kind of juggling their dual mandate?
Well, I think if we can continue to have the economy grow and have the interest rates come down to a more normal rate, we'll be set up to have the economy continue to grow. The interest rates being high can stifle that kind of growth. So I think that that's what we want to see. If we continue to see that, if they continue to look at the data and make data-driven decisions, that's going to be very positive, not only for the labor market, but for all the people in it.
Elise Gould, thanks so much for taking the time here today. Appreciate it.
Thank you.
Well, a growing number of CEOs are pushing for a full 5 days per week in office. Yeah, I think we used to do that. And workers, they're not enthused. Joining us now with the latest, we've got Yahoo Finance's Carrie Hannon. Hey, Carrie.
Hey, Brad. Great to be here. This is set up to be the workplace challenge of 2025. We're seeing, it's starting to gain traction. CEOs at Amazon and Starbucks and perhaps even the federal government are saying get back in the office 5 days a week to their office workers. And, it's a little shocking to the fact that, workers really have become quite enamored with the idea of working remotely, even if it's flexible, half in, a little hybrid, what have you. But what we're seeing is a recent report said 8 in 10 CEOs said that they expect their workers to be back in the office over the next 3 years. And that jumped up just recently from about 30% at the beginning of this year. So you can see the enthusiasm for getting workers back in the office is really gaining. But and even to get them to come in, about the report I saw said 86% said, oh my gosh, we'll give you raises, we'll give you promotions. There's lots of carrots, but then there's the stick that Amazon and some of the others have said, yeah, if you don't want to come back, then brush off your resume, okay? On the other hand, Brad, we're seeing that workers, 8 in 10 say, hey, we really want flexible work, and about 50% said they would they'd skip their pay raise. This is according to a Schwab study. They'd skip their pay raise in order to be able to work flexibly. So we're seeing quite this disconnect in what's going on and what will happen in this whole sort of tension around, should I stay or should I go in kind of thing.
Yeah, I mean, especially when some of these companies were virtual and were work remote type positions, especially even prior to the pandemic too. So it's really remarkable to hear about some of the changes. Which industries are more likely to have remote work options then?
Yeah, Brad, obviously, if we look at things like, digital jobs like, digital marketing, or even some financial jobs there, software development, IT, these kinds of things where you can really do mostly it's computer-based work, and it's not so dependent on having any kind of face-to-face interaction. So we're seeing some of those areas where there's going to be more. But the fact is, a recent study I saw from the big jobs board showed that these jobs available for these remote jobs, high-paying ones, are really on the rise. So I think that's something we need to at Ladders is the one who did that study. And I think it's important to take note that, as we just heard, workers, job seekers have growing confidence in the number of openings. And so we may see more people saying, okay, I will quit. And in fact, a study I saw from PayScale shows that people who work remotely are less likely to quit voluntarily than those who are forced to come back in some way. About double the number who have to work in an office are more likely to be willing to quit voluntarily. And if they're upbeat about job opportunities, we may see more. So all I'm saying, Brad, is expect more ahead of this sort of tug and pull about what we're going to see, whether people are going to go in or not.
Yeah, maybe we'll see an afternoon siesta a la Spain kind of lobbed into the negotiation table. Who knows, Carrie? Or a la Miranda Priestley from Devil Wears Prada. Who knows? Anyway, Carrie, thanks so much for taking the time. We're going to be watching this going into 2025. We know you will too.
Great to be here.
Well, President-elect Trump is set to take office in January and, on the campaign trail, pledged to make updates to the tax code, including making his 2017 Tax Cuts and Jobs Act permanent. Tax expert Sophia Duffy joins me now in studio. Sophia, great to have you here with us. So how might Trump change our taxes, and what would be the permanence of that?
Well, I would be remiss if we didn't talk about a little bit of end-of-year tax planning as well. So we're entering December. We know that there are some kind of last-minute tax reductions that we can take advantage of, like tax loss harvesting and all that. But as far as the incoming administration for President-elect Trump, we know that he has pledged to make those provisions permanent, meaning it's sort of status quo for the things that we've been doing so far, right, since the Tax Cuts and Jobs Act was implemented. So taking advantage of small business owner deductions, the standard deduction. But we also are seeing many proposals that are new and may create a different impact for us. So one of the proposals, for example, is eliminating income tax on tips and overtime. And that could really change the way that wages are structured, particularly for small business owners. They may be able to offer incentives to some employees. They may find that very attractive, right, if more of their wages are paid in tips, for example. And then there's another proposal to reduce the corporate income tax rate to 15%. So it was reduced to 21% under the Tax Cuts and Jobs Act, and that will further be reduced to 15%. Now, if that happens, we may see more and more small business owners converting their entities to corporations. So as far as planning today, we don't really know what to do today, right? Because we don't know if any of those will come to fruition. But what we could do, and what a smart planning step may be, is prepare for that. Do some research today and say, does converting to a corporation make sense for my entity? Does creating, a different wage structure for my employees makes sense, and doing that research today so that we could effectively pull that trigger if the time does come. And also if it makes sense for the business. We don't want to convert to a corporation and then find out we're paying more in legal fees than we're saving in taxes, right? So as long as it makes sense for the business, but doing that planning today could be very beneficial to taxpayers.
You talk about some of the planning that can be done today. I mean, we have 133 days until April 15th. What should people be doing right now?
So today, I mean, there's a few last minute tax impacts that we can implement today. For example, increasing charitable deductions so that we go over, the standard deduction might make sense. We could also take advantage of a strategy called tax loss harvesting. So I know we're reaching record highs in the stock market. This may be a little bit more difficult, but for anywhere where we've seen losses, you can actually realize that loss today and then use that to offset some capital gains with other investments.
Does any of this have impacts for how people prepare for retirement as well?
Retirement, there's so many things going on with retirement. So not only just with the incoming administration, but we know that there are some regulatory changes that have happened recently, such as the Secure Act 1.0, 2.0, that have made contributions towards retirement plans easier, right, for the American public. And that was meant to address this kind of widening retirement gap that we see. There's also some sort of looming threats, right? So even though retirement plans are easier to contribute to, they're more flexible, customizable, we know that the Social Security Trust Fund, by 2033, it won't be able to meet its current obligations. So what I would imagine may happen, or some proposals that have been on the table, are things like pushing back the full retirement age a few years, increasing the Social Security wage base so that more of wages are taxable for Social Security, and then maybe eventually even seeing a reduction in benefits by almost as much as 21% for some taxpayers. Those types of provisions, if they're implemented, will help increase the longevity of the trust fund. And then we're also seeing some consumers proactively planning for that, right? Social Security used to be sort of the crux of a retirement plan.
Right.
But as consumers are starting to realize that maybe they can't rely on that as much as they used to, we're seeing a shift towards planning vehicles like annuities to kind of replace that fixed income of Social Security. And then also we've seen an embracing of Roth IRAs and Roth conversions, because they may anticipate that, yeah, my taxes are probably going to go up over time, right? It's just not feasible to think that they're going to stay low or at the current rate forever. So by doing those Roth conversions and contributing to Roth IRAs, whatever tax impacts may happen down the road, we can kind of mitigate that risk today.
As the Fed continues to combat inflation, how should people who are close to retirement best plan their nest egg for the ability to outlast future years of inflation as well?
This is where a financial advisor can really help individuals. And tax planning is such an integral part of retirement planning, right? They really go hand in hand. An advisor can really help individuals to understand how to reduce that long-term tax impact across all phases. So even if you're 15 years out from retirement, it's not a bad idea to meet with an advisor and say, how much should I be contributing today? Sure. And what would make sense so that the tax drag on my long-term portfolio is as low as it can be? We're not going to eliminate it. Then there's people in retirement or maybe a few years out. How are their tax strategies going to change as far as that long-term impact? And then eventually, many people don't even think about this until they're entering their 60s and 70s, but how can I leave my assets to my beneficiaries and my heirs and have the lowest tax drag on that as well? And that's where advisors, specifically advisors that are educated in tax planning, can really help clients, small business owners in particular, to meet those needs and be able to create a financially secure future.
Sophia, thanks so much for making the trip up from Philadelphia, joining us here in New York City on set. Appreciate it. Coming up, everyone, your Yahoo Finance Market Minute. We'll check out how stocks are moving and run through 3 stories that you do not want to miss. Stay tuned.
We're 2 hours into the trading day, and it's time for Yahoo Finance's Market Minute. Stocks are mixed. The Dow and the S&P in the red, while the Nasdaq the only one in the green so far. And here are 3 trending headlines that we're watching so far. Shopify merchants hit a record $11.5 billion in Thanksgiving scales through Cyber Monday, with shoppers spending $4.6 million a minute on Black Friday. And a £1 billion lawsuit in the UK claims Microsoft overcharges for using its software on rival cloud platforms from Amazon, Google, and Alibaba versus its own Azure platform. And South Korea's won hit a 2-year low against the dollar, and tech-heavy ETF EWY with Samsung as its biggest holding falls to a 52-week low after emergency martial law was declared. And that's your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. More wealth when we return.
In May of 2023, Cameo, the online platform that lets people request personalized video messages from celebrities, pivoted its business to allow, well, just about anyone to join its community of creators. The new program, dubbed Cameo X, has attracted 31,000 new self-enrolled creators in 18 months. Here to talk about the transformation of the business, we've got Cameo CEO Stephen Galanis. Great to have you here with us on set.
Thanks for having me.
So let's talk about this. Why the transformation? Why the pivot from just super high, well-known, visible celebrities to just about anyone, as we mentioned?
I think, first off, the nature of fame has changed so much, especially in the 8 years since we started the platform. And what has become really apparent is people can blow up kind of overnight with the new tools like SoundCloud and TikTok and YouTube, and how fast that changes. So what actually happened was, we looked back in May 2023 at all the talent that had applied to join Cameo from March of 2020, the beginning of COVID, through that time. There were over 100,000 people that had applied. What they do when they apply was they said how many followers they had at that point.
Okay.
When we looked back and we checked at how that had changed, there were thousands of people we missed that might have, maybe they were an actor that hadn't had their big break on Netflix yet. Maybe they were a musician who hadn't had their breakout song. Maybe they were a college athlete who had applied before the NIL rules changed, and all of a sudden they're starting on the Giants or the Knicks right now. So we realized that we missed people, and when we think about the way that fame has changed, it's become a lot more niche. When our parents were growing up, there was ABC, NBC, CBS, there was no other television. When we were growing up, there was cable, there were 40 stations. Then there was satellite, there were 1,000. And now for kids today, every single person's their own platform, their own channel. So
Right.
there's literally millions of stations, and fandoms become more niche.
Talk about the gig economy of becoming your own channel and how you've seen people be able to do that successfully.
Yeah, look, I think it starts with the premise that the creator economy, if you want to be a full-time content creator, and there's 50 million people in the world that want to do that today, it all starts with being able to make $100,000 a year, pay your rent, allow you to not have a job. To go do that, probably the most efficient way is to find 1,000 people willing to spend $100 a year on you. And if you can go do that, that's kind of the minimum threshold to really earning a living and being able to do this full time. So when we look at Cameo, it's one of 4 major ways people can monetize on the internet. They can have subscriptions, so think OnlyFans, Patreon. They can sell business shout outs, so think influencer marketing.
Mm-hmm.
They can sell physical goods, think selling tequila or merch, or they can do digital goods. And the thing that's cool about Cameo is when you get a Cameo from someone, you like them more than you liked them before.
Yeah.
So that helps, that person, because they're a bigger fan, they're going to subscribe to you, they're going to buy your tickets, they're going to buy your other products.
How do I make sure that if I'm on Cameo, I'm not getting just cooked by the success of a puppet that you've got on there, Mona?
Well, I mean, everybody is right now, and it's been an absolute revelation. One of the new talent that's come through on this Cameo X is this puppet, Mona. And the cool thing about Mona is Mona had applied to join the platform for years. We had never let them on because they didn't have a social following of 25,000. We've let them on, and Mona's made over $600,000 this year and has been the #1 new talent in the world on Cameo in the past 12 months.
Talk about this pivot that you've made for yourself as well. I mean, you think about what the initial investments are for companies like Cameo, and it had been called into question the financial viability for Cameo a few years back, I believe. And so now, as you've continued to navigate this environment and see what the next leg or inflection point can be for the business, what have you got your sights set on at this point?
It's not a change, the policy change isn't necessarily a transformation of the business. We've always wanted to create tools to help talent have enable direct-to-fan monetization with their fans. And basically the idea is you get famous on other platforms, you don't make money from those platforms, you come to Cameo to turn your fans into paying super fans. That's what we've always tried to do. And the big thing that we learned was that as fandoms become even more niche, like our threshold was just too high and we needed to go lower because we missed people that were going to be the viral sensation. Today, you can say something stupid on the streets of Nashville and then a week later have the #3 podcast.
Are we talking about Hawk Tua has seriously made it to the Yahoo Finance lexicon here?
Of course.
Okay.
Right? But if you don't do, if you ignore that phenomenon, like it's crazy. So our whole thing is like somebody like her, if she could have been on before that video pops up, it's a lot easier to get her than when you're chasing her after she's, now has this huge podcast.
Certainly. Just lastly, your own career transition, your own pivot, how have you kind of orchestrated this ascension to the CEO of Cameo and really growing out this business from here? What do you prioritize?
Look, I think anytime you're talking about CEO, there's really 5 things that matter. First, product market fit. Do you have something that your customers want? Secondly, it's about building out an amazing leadership team. As a frontline CEO, you need to hire great people that can hire great people and, take what you say and bring it down. Third, you need, communication and alignment. Does everybody know what you're doing? Do they know your mission, vision, values? Fourth, employee engagement. Do they love working for you? If you have employees that love working for you, they're inspired by the leaders, there's product market fit, and they know what, they're jive with the mission, vision, values, they're going to tell their best friends, the most talented people they know to come work for you. And then the 5th one, and these are stack ranked in order, by the way, the 5th one is keeping the lights on. So, that can be fundraising, but, very often, especially in the last couple of years, that was doing everything it took to save the business, to make sure that this platform, which has paid out over $310 million to talent since it started, remains a viable going concern.
Absolutely. Stephen Galanis, who is the CEO of Cameo. Thanks so much for taking the time.
Thank you so much.
Absolutely. Everyone, we've got much more on wealth after the break. You're watching Yahoo Finance. While the big holiday shopping weekend is over, there are likely still a few things on your list that you haven't ticked off yet. So, how do you budget for these costs now that the deals days are done? Joining me now on the desk, we've got Tiffany Alichet, who is the budgetnista. She is the host of the Money Glow Up podcast as well. Great to have you here on studio.
Great to be here, Brad.
All right, so, as we're thinking about budgeting for holiday gifts, what are some checklist items that people need to keep in mind while they're going down their checklist?
Well, what I like to do is I like to be a little Santa Claus, make a list, check it twice, see who's been naughty or nice.
Yes.
So one, you don't always have to go into the stores. You're actually going to probably find better deals right there on your phone or on your laptop.
And save gas money.
Yes. And so you can make your list literally and start to ask yourself, who can I purchase things for? And link those people to those things and wait for those deals to pop. Also, there are applications that will allow you to find coupons automatically, and those applications are free.
Yeah. So how can we use rewards strategically for holiday shopping as well? Say I just want to put a bunch of points towards some of the gifts that I'm going to be giving.
So for example, I have an Amex card. There's a company called Points.me that they've recently acquired. And you can use it. There's an algorithm that they allow you to use to see how best to maximize those points. So I would not suggest using the points directly on the card site, that instead using one of those algorithm sites to see how can I maximize these points. So do I need to transfer this to a specific card? Do I need to transfer to a specific account? Because I'll give you an example, a flight that I was looking to help my friend book, her and her family, it would have been 250,000 points per person. So 750,000 points.
Ooh.
And because I was able to use Points.me, I was able to gift her that flight, 250,000 for all 3 of her family members.
Oh, that's great.
So you really want to make sure that you maximize your points. And are you linking them? Like, I don't know if folks know right now, Amex doesn't pay me. But if you link your Amex to your Uber, you can get points from and who doesn't Uber Eats every other day?
I'm trying not to.
Yes, but I'm just saying you can rack up points for doing the thing you're doing already.
Right.
So, yes.
Just lastly, while we have you here, we're going into overtime. Debt. How do you make sure that as you're doing and going about your holiday spending that you're not making sure that you go too far, or making sure that you're not going too far into debt as well?
Honestly, set aside your money ahead of time. Decide ahead of time now and start to make the phone calls. I've got 4 sisters. We decided years ago we're not buying individual gifts for everyone. We use this website called Elfster, where it will generate what sister that you're going to buy a gift for. We set a budget. And so that way I only buy 1 big gift instead of 4. So decide ahead of time what you're going to spend, manage expectations with family and friends, and really try your best to do that thing at home, not in store.
You reminded me, I got to do some work on my Secret Santa.
And watch Money Glow Up.
And watch Money Glow Up as well. Thanks for joining me, Tiffany. Appreciate it. And if you want more Tiffany, as we were mentioning, step into the classroom with Money Glow Up every Thursday, 12 p.m. Eastern Time on your favorite podcast platform. Well, what does it take to be wealthy? It's the big question. Nearly 2,000 Americans, they're weighing in. And for Fidelity's first ever State of Wealth Mobility Study. Here with the results, we've got David Peterson, Fidelity Head of Advanced Wealth Solutions. David, let's just start there. How many Americans actually consider themselves wealthy?
Hey, Brad, it's great to be with you. Thanks for having me. It's interesting, the survey found that only 10% of Americans consider themselves wealthy today. And while it's probably not surprising that such a small number consider themselves wealthy, what may be surprising is that the number is consistent across income and asset levels. In other words, what the survey found is that having a great deal of wealth doesn't necessarily determine whether someone actually feels wealthy.
So what is that rubric? What are the parameters that Americans set to identify wealth?
Yeah, it's a great question. Our study found that for most Americans, the definition of what it means to be wealthy is relatively modest. For many, a major criterion for feeling wealthy is simply not living paycheck to paycheck. High net worth individuals, now these are individuals that have $1 million or more in savings and investments, not including retirement accounts or real estate. They're expectedly more likely to associate feeling wealthy with also being able to travel and take vacations, as well as give back to charities. However, an equal share of high net worth and non-high net worth individuals attribute feeling wealthy to home ownership.
So for the roughly 10% who identify as wealthy, how did you find that they built that wealth?
Yeah, for the 10th who consider themselves wealthy, basically, there are 3 things that boil down to how they achieve that in their minds. One is investing strategically. The other is saving from a young age. You can't beat the power of compounding after all. And finally, it's consistently allocating part of their paycheck to savings, being really systematic about it. Now, going back to that first one, investing strategically, we know that this can be intimidating for most. Our survey also found that the majority, 78% of Americans, wish they were better investors than they are today. However, in our view, it doesn't have to be intimidating because you can always outsource it. At Fidelity, for example, we're constantly focused on innovating financial solutions to help people plan for the future they want. It's why this year we've expanded access to our personalized wealth management offering enabled by the Unified Managed Household or UMH platform. This platform provides a goal-based planning and investment management approach across a household in a really tax smart way. Now, UMH is highly regarded in the wealth management industry. However, historically, it's been exclusive to only certain wealthy individuals, typically those with over 10 million available for investment. Today at Fidelity, advisory clients with a minimum investment of $50,000 have access.
Certainly. Just as we're hustling to the finish here, one of the other things that we're going to be tracking, and we've seen a range of somewhere between $84 trillion, I think that was put out there by Cerulli Associates, and even upwards of $90 trillion, going to be wrapped up in this great wealth transfer and expected to change hands over the next few decades. That might involve some tough money conversations. What did the report have to say about people's preparedness to pass down wealth?
Well, it's also a great question. What it found is that most people historically have not spoken about wealth and how they've accumulated wealth and what their plans are for transferring wealth, but most wish they had. So something like 80% of families have not had that conversation, but over 60% want to have it. So, the reluctance is typically with older generations. And, one way to kick off conversations really is to chat about how you've established your own estate plan to protect your loved ones in the event of a crisis, or casually toss out that you've heard recently how important it is that kids have access to their parents' personal financial information in case they ever need help managing their money. Mm-hmm. And, while it's never easy to start such a conversation, the important thing is not to wait to do it, to make the most of cherishing your time with loved ones. It's really critical to have these conversations.
Absolutely agree. David, thank you so much for taking the time here today. Some really interesting findings from the survey as well. Appreciate it.
Thank you.
In this week's episode of Decoding Retirement, host Bob Powell speaks to Charles Schwab's Liz Ann Saunders about how market uncertainty can affect your retirement planning.
It's overused to talk about uncertainty and the impact it has on markets, but I think this is a uniquely high amount of uncertainty, not just because of the knowledge we have of Trump and the first administration, but how policy got affected, especially on trade in that 2018 period, where it was often by tweet. So that's an added wrinkle into trying to figure out what's going to happen when and to what extreme.
And you can catch Decoding Retirement Tuesdays at 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Let's get another check-in on the markets as we are approaching 12 noon Eastern Time. We're taking a look at the Dow, the S&P 500, both of those in negative territory fractionally. However, the Nasdaq Composite flat just barely to the upside, holding on to gains by about 0.07%. That's it for Wealth. I'm Brad Smith. Thank you so much for watching, and you can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up 3 p.m. Eastern Time. They'll count you down to and through the market close.